to see a house full. Welcome all of you. Hello and a very good evening to all of you. Welcome to Nucleus Software presents CNBC-TV18 presents Banking Transformation Summit. I'm your host, Mugdha Kaldra. In a world of perpetual change where innovation shapes destinies and ideas reshape industries, the banking sector emerges as a pivotal force in shaping the narrative of India's economic growth. Today, we stand on the cusp of a transformative era where aspirations converge with opportunities, and the banking industry plays a catalytic role in propelling India towards the monumental goal of a $5 trillion economy. Keeping that in mind, CNBC-TV18 Banking Transformation Summit serves as a beacon guiding us through the labyrinth of challenges and opportunities that lie ahead. It aims to explore the connection between India's economic growth and the transformation of the banking sector driven by digital technologies. Tonight, this summit has brought together industry leaders, policymakers, and financial experts to assess the transformation in the Indian banking sector and explore its future prospects, providing a holistic 360-degree view of the evolving landscape. And now, ladies and gentlemen, to set the tone for the evening, may I please invite CNBC-TV18's Managing Editor, Shireen to deliver the welcome address.
Thank you very much, Mugdha. Good evening, ladies and gentlemen. It's so lovely to see all of you here at the first inaugural edition of the CNBC-TV18 Banking Transformation Summit. On behalf of my colleague Lata Venkatesh and myself, thank you so much to each and every one of you for joining us here this evening. As you're well aware, from the 9 a.m. cutoff for high-value checks to now being able to transfer your money from your smartphone, the possibility of buying a ticket for the Louvre in France through a made-in-India fintech platform with real-time conversion of the rupee to a foreign currency, banking transformation is an undeniable reality, ladies and gentlemen, and you in this audience have seen the change firsthand. The banking industry in India is historically one of the most stable systems globally, and that is despite the fact that we've seen significant global upheavals and headwinds. With the massive infrastructure of bank branches, ATMs, rural and urban areas today see a coverage of almost 100% across the length and breadth of this country. In fact, the total bank deposit stands at over 175 trillion rupees, or almost 68% of the GDP. The good news, gross non-performing assets of scheduled commercial banks continues to see a downward trend, declining to a 10-year low of 3.9% in the month of March for 2023. At the same time, we are also in the midst of a fintech revolution. India has the highest fintech adoption rate of 87%, which is significantly higher than the global average of 64%. For the first time, we're also now seeing an international acceptance of a made-in-India payment system. The incredible success of the unified payment interface has been a watershed moment for digital payments in India. Legacy banking institutions are also today collaborating with fintech players to harness emerging technologies and create quick, engaging, and secure customer experiences. At the back end, ladies and gentlemen, technology adoption is leading to a reduction in operational costs and it's increasing workforce productivity. Together, innovation and collaboration in the BFSI space do ensure the long-term efficiency as well as resilience of India's banking sector. This is despite unprecedented events that we are still seeing. In the background of the numbers that reflect positivity and hope, there is an ensuing war on in Central Europe that has threatened global supply chains, an energy crisis that India has somewhat navigated better than many developed nations, and the incidence of wildfires and unexpected weather behavior which directly feed into food inflation. We still have the pandemic whose economic impact is playing out. Transformation in this scenario is indeed an achievement. Banks are at the heart of any economy. Banks grow the economy, and as the economy grows, the banking sector grows as well. Some of the stalwarts of the country's largest financial companies, the financial ecosystem, join us this evening to share their ideas and experiences, to share why one should be banking on the Indian economy and the Indian banking system. We will, of course, see plenty of dialogue and conversation on how India can navigate her way to the $5 trillion mark and beyond. So once again, ladies and gentlemen, on behalf of the entire CNBC TV18 team, I would like to thank you all for joining us here for the first edition of the Banking Transformation Summit. We hope to make this a marquee annual event where we will see conversation and dialogue about India's financial sector take shape and drive change. Once again, thank you very, very much for being here this evening.
All right, we now have a very special fireside chat called Equipping a New India. And now, ladies and gentlemen, get ready to be intrigued by the thoughts of a very special gentleman, a visionary whose name resonates through the financial corridors of our nation. He has not only propelled his institution to new heights, but he has also left an indelible mark on the entire banking industry. Please welcome on stage with a huge round of applause, Uday Kotak, MD and CEO, Kotak Mahindra Bank.
Mr. Kotak, thank you so much for joining us here as our inaugural speaker for the inaugural edition of the CNBC TV18 Banking Summit. It is indeed a pleasure to have you here today. Ladies and gentlemen, while we would hope that all eyes on the Banking Transformation Summit, we're also aware of the fact that the world's eyes are on India's moonshot moment, the Chandrayaan-3, virtually in the last lap now, about an hour and a half away from making that landing on the surface of the moon. What a moment it is for the country, Mr. Kotak.
Absolutely, and it's quite amazing that two major events are happening today. One is the Chandrayaan moment, and I hope India really succeeds in having a smooth landing. And at the same time, I'm looking forward to chess and India becoming the world leader in chess. Can you imagine if we, and I'm keeping my fingers crossed, if we get it both right, we will be at the top of science and knowledge.
Absolutely, at the top of science and knowledge. And here's wishing the team at ISRO and Pragnanda the very best of luck for both those. But since we are talking about the moonshot opportunity, Mr. Kotak, let me talk to you about the moonshot opportunity for India's banking sector. You've seen the financial services sector evolve since the time that you took charge, in a sense, of an NBFC and then, of course, the bank in 2003. From your vantage point today, what could be the moonshot moment for India's financial services sector?
I think if I look back and then look forward, India has come a long way. In the 90s, my biggest concern was the export of the Indian capital markets. That we had a flurry of issuances of Indian companies listing at Luxembourg. And we did not even have the concept of a private placement in India. And it bothered me a lot that Indian companies were listing in a completely unknown exchange with virtually no trading, but companies preferred that to public issuances. From there to now say that we have one of the most active markets, probably highest in terms of number of transactions, to any global player anywhere in the world being able to trade on Indian exchanges, it's a huge step forward. The quality of the equity markets and now the depth of the equity markets should make all of us feel great. But beyond that, I think the debt market has more work to be done. And I think time has come for us to dramatically up our ambition. The financial sector should be the engine which supports India's aspiration. And I'm looking forward to India becoming a 30 trillion economy by 2047. And what does it take for us to get there, and what is the role of the financial sector as we go into that journey?
You know, since you're talking about ambition and aspiration, let me ask you about the appetite of the financial sector. We'll talk about 30 trillion later, but let's talk about 5 trillion because that is the next milestone that we're hoping to clock. In the journey to 5 trillion, do you believe that both in terms of capital as well as in terms of appetite, the financial sector has enough of both?
I think the financial sector is much stronger today than I've seen it. And if we started it, say, if we looked at the first part when COVID really hit us, most of us didn't know what was happening. From there to where we are, I think we've made a significant progress. I think we are actually in a very good shape. The balance sheets of companies are healthy. The balance sheets of banks are very healthy. Capital adequacy is in good shape. And this is the time for India to, while managing risk, really scale up in its aspiration for building new capacities and new capabilities in the financial sector.
When you talk about new capacities in the financial sector, do you believe that we have too few banks, not just too few large banks, but do you believe in general that we have too few banks as we look at this $5 to $30 trillion milestone?
I think it's not just about numbers, it's about scale and capability. And we really need to go up the curve on that. Like, let me give the two areas which we really can do a lot more. Let's take the case of the bankruptcy law. You know, if we really want the financial sector and the banking sector to take off, we really need a resolution process, which we started with good intent, but we seem to be having challenges on the way. How can we have the declogging of the NCLT process, the judicial process? You need quick resolution and much better resolution. The recoveries which are coming for loans which have had trouble are much less than what they should be. Therefore, as India grows, you cannot have a system where the credit cost is so high because of a very high resolution cost in case of a loan getting bad. We are in a Goldilocks period. This is the time, in good times, you get things right which stay with you in the tougher times. So that is one. And second, I think there has been a significant growth in the financing of retail India in the last 10 to 20 years from a banking point of view. But corporate India will also have to gear up for a much larger role in terms of scale. And it is here that banks will have to sharpen their underwriting skills and ability to write big checks. The last thing I want is a corporate which wants to acquire another business in India has to go to an overseas bank outside India to fund an acquisition.
So what's holding Indian banks back? What's the constraint at this point in time, especially when you talk about acquisition financing? And do you really believe that we are going to see big ticket deals, big value deals? There's a lot of talk at this point in time around the role that private equity will play, whether it's in the pharma sector specifically, which is the big deal that everyone is talking about, the potential of Cipla, going through. But what do you believe is the need of the hour in terms of acquisition financing when you talk about the role that Indian banks will play?
I think two major areas where India can do more as the Indian financial sector. One is significant capacity building and addition to the private equity industry in India. Bulk of the private equity financing today is happening by global private equity operating in India. And a lot of them take their leverage outside India because leverage in India is not available to them. So we really need to do two things: dramatically increase Indian private equity firms to get larger. And second is we must get comfortable and confident that Indian banks and financial institutions have underwriting capacity and capability, and they don't need to be excessively protected from the business, which will be crucial for India's growth as we go forward.
So you're essentially talking about regulatory changes to ensure that happens. My
view is that this is over time. India must have the ability to get to scale both in banking and in the corporate sector.
You know, since we're talking about scale and not just in the banking sector, Mr. Kotak, I want to understand from you how you see the landscape changing. We've just seen this big HDFC Bank deal go through. Do you believe we're on the cusp of seeing a significant amount of consolidation across sectors in India today?
I think we are seeing a lot of consolidation in many sectors as I speak with you. And there cannot be a better platform than to talk about the telecom sector consolidation. You've seen it. You're down to 2.5 players, 2.5 serious players in the telecom sector. You look at the airline industry. I mean, it's consolidated phenomenally. You look at the steel industry. It's consolidated significantly. And essentially, two big players have a disproportionate market share. Therefore, sector after sector, you're seeing consolidation and concentration in fewer hands. I'm not against consolidation as long as we keep the competitive intensity in place. So if you compare banking to these sectors, let me ask you the question, do we have too many banks or too few banks?
I asked you that question
So
to
I'm
start
giving it
with.
back.
Which camp do you belong to?
My view is it's not about quantity, it's
about size.
quality and making sure there is enough competition. If you look at most of the developed markets, you have got now seriously 5 or 6 significantly large players and then a whole host of smaller players and niche players and specialized players. I think India needs to get more in that direction and let at the same time the niche and the smaller players can bring up the competitive element. I think the whole digital revolution is changing the landscape of financial services. Most of us here think about financial services as domain. More and more we need to start thinking about it as technology plus domain.
If you are talking about technology plus domain, I'll get to that in just a second, but I want to just continue on the consolidation aspect because you've seen a fair degree of that within the bank as well. But what do you foresee specifically for the banking sector? You gave us a whole host of other sectors where we have seen a fair degree, some, because players have just exited the market, and we've seen that even as far as the aviation sector is concerned. But what do you believe you foresee for the banking sector specifically, and will you continue to play consolidator, a role that you have played previously?
See, I think don't expect, especially in the public sector, anything major till 2024 middle. But beyond that, I mean, my view is maybe we need 4 or 5 large public sector banks, and beyond that, it should be completely open for consolidation within banking. And we must make rules easier. We must be ready to let some of the public sector banks also raise more public market equity so that their holding goes to below 50%. And a whole host of things to encourage consolidation quickly, because technology otherwise will consolidate the sector in a way which may not be favorable for many of the existing players.
Speaking of possible changes and possibilities for the banking sector, I want to, ask you about what you made of the recent decision by the Mahindra Group to pick up a stake in RBL Bank. And the expectation is that perhaps at some point there will be a review or a rethink on whether corporates should be allowed into the banking sector or not. And we don't know whether that is in any form or fashion on the anvil or will be on the anvil. But your thoughts on that?
I think my fundamental view, and this is not a protectionist view, is one of the biggest issues in Indian banking history goes back to the whole basis on which banks were nationalized, where it was a case of large houses having stakes in banks, and we all know it. Central Bank was Tata's, UCO Bank was Birla's, and you had a situation where there is inherent conflict of interest, even if there is no direct lending. A direct lending by a bank to a business group is obviously not correct. But you can have indirect lending through the vendors, to the service providers. There can be so many linkages which can happen. And fundamentally, banking is a high leverage, high risk business. Not many corporates in the world get leverage at 10, 12, 14:1. And banking is one such business. You have to keep this fact in mind, that such high levels of risk in the system and the contagion which a banking failure creates in a system actually make a strong case of having banks independent of business houses.
So keep the doors shut.
This is my view because of inherent conflicts of interest and the risk of self-dealing.
Let's now talk about technology, and you talked about how this confluence of banking and technology is actually going to lead to many more changes within the sector. In your experience, as you look at how this is played out today with the collaboration that banks have seen with fintechs, we've gone from that journey where it was whether the fintechs will survive to will the bank survive, to now a happy coexistence of the two and a happy collaboration and partnership of the two. How do you see this moving forward?
I think we will get it to a world of what I call as co-opetition. There will be areas where banks and non-banks, particularly the technology companies, will compete. And there will be areas where they will cooperate. And in that context, I actually feel that banks have been behind the curve. The whole payment space, to think about a Phone Pay and a Google Pay moving to a more than 85 or a 90% market share, while it was for the banks to take it, is a reflection of how nimble-footed players can take the lunch which long-term belonged to the banks. And we just gave it away as a banking industry. And if we are not careful, if we are too much comfortable with the moat we have, we have run the serious risk of becoming a pure utility with the front end moving to what I would call as the consumer tech players.
So can you get your lunch back, or is that now that boat has sailed, that ship has sailed?
In my view, again, the same issue comes there in the payment space. It's concentration. Two players own the market. So, and NPCI has talked about market share not more than 30%. But when it came time to implement it, they asked for 2 more years to be able to implement the rule of 30% maximum cap. So how are we going to handle the risk of monopoly power coming out of consumer tech is an issue which we need to address. And that is something which is the complete opposite of what you're seeing in the traditional banking in India, which is lots of players, lots of new players coming in, versus monopoly power, which consumer tech has the capability, where volumes just move in one direction. And I think payment system in India is a classic example of how quickly consolidation of power happens.
Given the fact that we're already seeing such a significant consolidation of power in the consumer tech and in the payment space specifically, what can banks do? I mean, does this keep you up at night?
In my view, banks have time on their side, but they got to use it quickly. And as far as I can see, we really, and that's something which we are doing front-footed, we are dramatically changing the persona of Kotak Mahindra Bank. We are clear. We have to move to be significantly tech first. We have a record number of engineers, as I talk to you, working in the bank and joining on a daily basis. We are changing the whole DNA of the bank as I speak with you, because unless we can get tech and domain in a box concept, we are going to head for a serious risk of becoming utilities.
How challenging is it? How complex is it? You talked about changing the very DNA of the bank to make it tech first. What have been the big lessons along the way as you move down this journey, as you make this pivot?
I think you need to start with a very simple emotion, paranoia. And if you get that emotion right, the rest will follow. Most of us in banking believe that we have a right to have the moat, the regulatory moat, and the fact that we are very comfortable with our current basis of operation as something which will protect us. We need to have the fear of death for us to really get our act together.
A fear of death as extreme as that?
As institutions. I mean, you just have, why is it extreme? Look at what has happened in the telecom sector. There were 13 players. What has happened to all of them? Look at the airline industry. Look at steel.
So you're saying that that could be a possibility if the banking sector doesn't disrupt itself?
Banking sector has to become a significantly more digital player. And the world was physical. Then we started talking about phygital, that is physical and digital, which is physical first, supported by digital. The world has moved to digital, which is digital first and physical supporting digital. That's where I see it go.
You talked about co-opetition and coexistence as well. And I wanted to stretch this argument to the context of banks and NBFCs as well. And we've seen a significant reduction as far as the regulatory arbitrage is concerned in this space. How do you see this co-opetition and coexistence over the next 5 to 10 years?
See, there is one myth widely prevalent, which is that the cost of funds of banks is cheaper than NBFCs. It's a myth. If you look at the cost of funds of an NBFC, there is no CRR, there is no SLR, there is no priority sector lending. The wholesale market for funds has developed a lot more with the mutual fund industry, debenture market, as also the insurance industry. Therefore, NBFC cost of funds for the top-rated NBFCs is no worse or not significantly negative than a bank. lower rated NBFCs cost goes up, rightly so. But for top rated NBFCs, being an NBFC is not a disadvantage on cost of funds. I think the myth that NBFC's cost of funds is higher is a complete myth. In fact, the top end AAA NBFCs in most of the times borrow at or lower than banks' rates, and they don't have a huge cost structure which banks have, which is branches, fixed cost and others. Therefore, NBFCs have the ability to compete on even terms on cost of funds. And that combined with no load of PSL, banks have 40% obligation on priority sector. So it is, I think, level playing for NBFCs today. And there is no question it is lighter touch regulation. The regulation in banking is significantly higher. Therefore, if you have lighter touch regulation, no disadvantage of cost of funds, I can well understand why many of the NBFCs don't want to become banks. And there are new players who will play the NBFC game without becoming a bank.
You know, you're talking about new players in the NBFC space. We've just seen a listing of the newest of them all. What do you make of that? And, you know, how would you describe this as a moment for the industry today, the potential moment for the industry today?
I believe the geofinancial services has significant opportunity to scale. And I have no doubt under the leadership of Mr. KV Kamath, they will do a phenomenal job. And I have always had the highest regard for Mr. Kamath and his ability to envision and execute.
What do you believe will be the key challenges that they will have to contend with?
I think it's a marketplace. It's also a leverage business. Therefore, the beauty about a leverage business is when you give out money, you got to get it back. And you're highly leveraged, so therefore your ability for making errors for any financial player is very limited ability to make mistakes. So as long as they follow the mantra, and Mr. Kamath knows this at the back of his hand, I have no doubt geofinancial services has a great potential. Well,
we'll have Mr. Kamath joining us in a short while from now, so we'll get to hear from him firsthand on what the vision really is as far as geofinancial services is concerned. But Mr. Kotak, let's also talk about the insurance sector, because that is again something that you believe it requires not just disruption but also unshackling in many ways. What is the roadmap that you would like to see for the insurance sector going forward?
Again, insurance are two very disparate areas. One is the life insurance business and the second is the non-life business. And within non-life, again, you have segments which is property and casualty or health. I think each of them has significant potential. What we need to really get on the life business, it's much more a physical business. On the non-life business, it's getting to be a lot more technology and digital driven. And I actually see a lot of innovation possible on the non-life business. I'm very excited about the health business for a country with such low population or such young population. Therefore, the road ahead for both the insurance businesses is looking extremely positive. And if we can develop our life insurance industry further, it will create long-term capital to finance India's capital needs for a 30 trillion. I'm going back to 30 trillion. I don't want to just look at 2 years. I want to look at the next 20, 25 years, how India can be a significant player on the global stage.
You know, you're talking about India being a significant player in the global stage and that $30 trillion aspiration that you just laid out for us. At a recent event where you were speaking, Mr. Kotak, you laid out the priorities, the top 10 priorities that India must focus on. And within that, it was also the role that the private sector should play in being able to address some of these crucial challenges, whether it's the energy challenge, it's the sustainability challenge. What is the role that you believe the private sector can play, especially from a financing point of view? And I don't just mean the banking sector.
Yeah, I just ask ourselves here, you know, we all stay in Mumbai. We know water levels in Mumbai are rising. And if we don't act, we run a very serious risk of the city going underwater. Let's ask each of us, what are we doing about it? Then I ask the same question to a Delhi wala. You're a Delhi wala. Yeah. So what are we doing to, as a country, to ensure that none of our cities are in the top 10 most polluted cities in the world? Therefore, rather than doing big sustainability concept, let's address the challenges that two of our major cities face, which is Mumbai and Delhi. What are we going to do individually? And what can we do to change the future of these two cities, which are so crucial for India's future. And if we can fix the big things like Bombay and Delhi, I think we'll fix the other cities quite easily.
But the question is how? How and where does the capital come from to fix it? One, of course, is the execution aspect, but it also requires a significant amount of capital to be able to fix both.
You know, I think there is a very big opportunity. India has been one of the leaders in an innovation which I call as CSR. When CSR was first announced, the 2% of profits, I felt this was a backdoor tax. Today, I feel it's one of the best things India has done, because we have created a pool of social capital, which is adding every year for being available to transform the country. And as corporate profits grow, as corporate India gets larger, 2% of profits every year creates a significant pool for us to have disproportionate amount of money go into sustainability as one of the objectives. And I think the money is there. And if you can create a format, for example, CSR combined with little bit from the government and then an institution which can leverage this money, we have a very potent combination.
Speaking of the road ahead, Mr. Kotak, I want to, before I get the audience to ask you a few questions as well, I want to delve a little deeper into the journey that you've had. And I don't know how many of you in this room know that he would have probably been playing an innings on the cricket pitch had it not been for a turn of events that led him to banking. As you look back at the innings today, before you start a fresh one, Mr. Kotak, in December, what's the big realization? What would you describe have been the big milestones that you're the proudest of?
I don't think it's about pride. It's individually, it's a pride for the country. The financial sector reform which India set off post-1985 and then post-92 and then subsequently in the 98-99 when the NBFC crisis hit to 2003 to the unleashing of the financial sector thereafter, and then the ability to pull back and get our financial sector back in shape after the post-2008-9 crisis to the very healthy position we are in today. India has done a lot in the financial sector. And when I look at this journey, I feel we have been fortunate products of India's financial sector reform. And there have been so many points of time when we felt we were on the edge of going out of business. But every time we were able to find solutions in a system which over this period was extremely supportive of doing the right things over time. And I still remember we started with bill discounting days in 1992 when we had the first security scam, the kind of stress and fear many of us went through, not because of our fault, but because of a boomerang of accidents coming around, to the NBFC crisis, post the Asian crisis in 1997-98. I remember there was something like 4,000 plus NBFCs in the late 90s. 3,900 plus died. And that people forget it. You remember the crisis at the UTI and many other places. So you saw the evolution of the NBFC sector. Then post 2001, we had another securities scandal. And then 2008, global financial crisis. And one of my big lessons out of 2008 was be very careful reading too much of the foreign media. And particularly...
Yes, keep watching CNBC-TV18.
The Wall Street Journal. I actually became very cautious. Oh, what's going wrong in the US? Because the Wall Street Journal said the whole world is going to collapse. I wish I had set up a lot more branches faster than I did, because I was too impacted by what foreign media said about what would happen. India actually rode it well. And India, the pressure came 3 or 4 years later in the terms of the corporate sector crisis. And along the way, I think managing risk and always making sure that, to use a cricketing terminology, irrespective of the wicket, making sure your technique is right. And if you have to have a cross bat, be very careful you have good practice and the ability to hit the shot like a Tendulkar or a Kohli. And if you don't have it, don't use it.
Well, I would imagine that you've tried to do a little bit of Tendulkar and Kohli at different points in time, Mr. Kotak. But, you know, you talked about some of the accidents that have shaped in many ways the evolution of India's financial sector. Today, we're talking about banks' balance sheets being in good shape, cleaner than they've ever been, at least in the past decade or so. What would you worry about? I mean, you know, there can, of course, be black swan events, and we hope that we don't have to contend with any of those. But outside of black swan events, what potential accidents would you be worried about that concern you today?
I don't think I have a concern, but you must always have, in your risk management lens, a question of what if. And some of the questions which come to my mind are, what if this inflation genie doesn't get back into the bottle? What if it just is out of control?
How worried are you about it today?
I would put a 5 to 10% probability of that really not coming under control. And something's changed because there's been so much of printing of money, and you're seeing some of it play out. And every time you feel that, you know, things are getting under control, something new happens. So I would look at, what if we're going to be having higher inflation for longer? The target in the US of 2%, or even the Indian target of 4%, is it something, do we change the goalposts because we don't think we can get the genie in the bottle? Or we try and get genie in the bottle? I don't know the answer. And it also depends on each country and the political landscape of that country. I think the rules of the game are changing. Look at the challenges which Europe is facing. I mean, the UK. UK, as I have said, had a history where sun never set on the British Empire, to the situation and the challenges they face today. Therefore, no country should take its success for granted. And right now, China, I think China, from what I understand, is going through tougher times than what we are seeing. Therefore, this is India's opportunity. But India has to manage this opportunity while managing the risks of what if.
You know, speaking of India's opportunity, and I think there is broad consensus that this is, you know, in many ways, all of the pieces have fallen into place at this point in time. It really is a question of execution, and it's on getting the strategy right and moving forward. Directionally, we are moving forward in the right direction. But on that front, when we talk about this being India's decade, India's moment, you know, the things that you're most confident about and the vulnerabilities that you would watch for.
I think I'm extremely confident about the fact that the macroeconomics of India is in a good place. And as long as oil does not go above $100 consistently for a long period of time, I think India has the ability to manage the macro pretty well. If you ask me, one of the most important things India needs to manage over the next 10 or 20 years is unity and diversity. And states and the country as a whole. Because you do see India being a very diverse country. And you have the United States of America, you have Europe. You've seen Europe is not United States of Europe. So India really needs to manage its unity and diversity over the next 10 to 20 years to be a solid, unified nation on core issues. There will always be differences because of the nature of the country. But within that diversity, which we must respect and encourage, we need a sense of unity and purpose of one country at all points of time.
Very well said, sir. Since you laid out the roadmap for the 30 trillion mark as far as the Indian economy is concerned, let me ask you to lay out for us the roadmap as far as the bank is concerned. You know, what is the aspiration that you have for the bank, especially now as you move closer to moving away? And I want to also ask you about what that process has been like for you to be able to start to distance yourself in a way and move away from an institution that you've been responsible for building.
I think one of the most important aspects of any of us is, if what you create does not outlive you, then it's not a true success. How do you ensure that the institutional framework of what you create can sustain individuals? I think individuals may start enterprise, but over time, the institution has to be ahead of the individual. And the job of the individual over time is to nurture and let it flourish, and the roles change. So how do you create world-class institutions? And the most telling example again is the United States. Once upon a time, there was a Mr. J.P. Morgan. There is none. And the institution lives on for a few hundred years. There was a Goldman, there was a Mr. Goldman, there was a Mr. Sachs, there was Morgan Stanley, of course, is an offshoot of the combined entity. There is a Merrill Lynch. All these were started by individuals and families. They have outlived the individuals and families to be global institutions. And I mean, look at even in the technology space, look at Apple. Most people thought it is Steve Jobs. He's gone. But Apple is all pervasive. So there's so much for us to be thinking about the institutional framework, and India needs to build that more than anything else.
So no Kotak in Kotak Mahindra Bank?
No, I think the fact of the matter is the brand is Kotak, but it's the institutional brand. And that is again in the spirit of governance. Day one, when we became a bank, we made sure that the brand Kotak belongs to the institution and not to the individual.
So what is the aspiration for Kotak Mahindra Bank? What is it that you would like the bank to be able to achieve over the next 5 to 10 years? What do you see for it?
I think we need to, for the future, we need to learn from the Apples, the Googles, the Amazons of the world, and we need to keep the spirit of the JP Morgans of the world. And how do you get a combination of both these at the same time to create an institution which India will be proud of?
Do you believe that you've been able to do that? Are you still in the process of being able to do that?
I think the institution's journey is, has some way to go. An individual has taken it up to a point, but the institution must grow and flourish.
And I know that I'm not going to be able to get anything more from you on succession, but confident of passing on the baton there?
I think I really would like to see this institution in the famous, which was a Tennyson poem, men may come and men may go, but I go on forever.
Absolutely. Ladies and gentlemen, well, you know, we look forward to the next leg of that journey, not just for you, but also for Kotak Mahindra Bank. I am going to open this up for a question or two. If you could raise your hands and please keep your questions very brief and pointed, we'll get a microphone across to you. Yes, sir. Go ahead.
Hi, this is Sanjay Panda. I was one of the few employees when the Kotak Bank was formed, and now in a tech side of a company. My question is that, and I am a Chief Minister awardee for social causes, the CSR things has been come up. That's how the question has been come up to Mr. Kotak. The Kotak Foundation and Kotak Karma is doing extremely well for the upbringing of the education for the girl child and other things. What is the future and what is the thinking ahead for those things from, and more about that side?
Yeah. I think, as I said, I think CSR is one of the most outstanding policies which India has. And if companies really implement it with passion and purpose, it is a huge opportunity for allocation of resources by people who can actually run and execute and organize well to make a big difference to society. And at Kotak, in terms of our approach to CSR, is essentially education is at the top of the list, sustainability is very much there, and we are also looking at some part in making a difference on the sports side. So we have kept our mandate pretty wide, but these are the three main areas where we will continue to focus. And we think about it as a pleasure and a duty to make our contribution for building a better India.
Yeah, yes, sir. Go ahead. We'll just get a microphone across to you. Can we get the mic here? Yes. Yeah, it's working. Go ahead, sir.
Sir, you talked about healthy competition. And one of the points you talked about is NPCI putting a 30% kind of a cap on payment processing fintechs. As a banker, let's say in future, RBI decides to put a similar cap for bankers. Would you welcome that move?
The good news is we are okay with 30%. We are currently between 2 and 3%.
Yes. Lata has a question, so I'm going to get the mic across to her. Right here. Lata, if you can raise your hand, he'll be able to identify you. Yeah.
I don't want to eat up somebody else's time. Mr. Kotak, actually, I got thinking when Shireen was asking you about your personal journey. You know, you're only 8 years younger to HDFC Bank. But HDFC Bank is what, 7 times your size now? And if you discount the HDFC merger, it would still be 15 lakh crore, I thought, and you would be what, 3.5?
Yeah.
So, are you an overprotective, overcautious banker? If you think back, would you have wanted to be more courageous? What would be your word of advice to the next guy?
I think it's a very good question. You got to keep a context in mind. Between 1994 and 2003, the public sector banks were not allowed opening up on technology. And a new bank with basic technology had a free hand for 8 to 9 years to really build on a technology platform, while public sector banks were subject to unions, restrictions to really go onto the technology piece. And the opening up of technology for all really happened after the first 8 or 10 years, which the first round of bankers, whether it's IndusInd Bank, whether it's HDFC Bank and others, had an advantage. The second big thing, which I think worked for HDFC Bank, is the brand HDFC. You know, we underestimate the power of the brand HDFC in the early stages. So when HDFC Bank was a child, brand HDFC was so much more established. And that combined with new technology was a complete open house, which HDFC Bank had, and I would give them credit for doing a brilliant job at that.
Well, I'll take one final question from the audience. There's several hands. Yes, sir. If you can just stand up, sir, they'll probably be able to spot you faster. Thank you so much.
Thank you.
Yeah, go ahead.
So good afternoon. My name is Nucleus Singh, and I'm a CISO of LIC. So the question is, you talked about various reforms on the financial sectors over these decades. What is your views on the regulatory landscape, what we have currently, and especially in terms of RBI, when we have gone through so many rough patches, and regulator has helped the entire financial sector to be sustained on the businesses. So what's your views, and how do you see that the regulator can be more proactive to help not only the banking sector but also the insurance to take it to the next level of journey of 5 trillion economy?
I think first, there are really two parts. I think the regulator has done an outstanding job, particularly in the last few years, especially managing the COVID era and the turbulence which we saw post that. And keep it in mind the backdrop of the whole NPA crisis which the banking system had. Therefore, in terms of navigating the financial system to the safe shores over the last 6, 8, 10 years, I think the Reserve Bank has done an outstanding job of getting us there. What we have to ask is the question that what will it take us from where we are to where we want to be? That is a separate discussion versus what was right for us, especially in the turbulence of the last 5 to 10 years. So the discussion has to be around how do we ensure all the good things we have learned over the last 5 to 10 years, we protect that, including high quality risk management, continuing improvement in processes. But how do we at the same time unleash and harness the opportunity of India for a 30 trillion economy while keeping our guardrails in place? And what are the capacity building measures we need to put in place for the future? And as distinct from the last 5 to 7 years, which brought us to the safe shores as was required.
So if I can just ask a follow-up on that, sir, which I tried to initially as well. What would you like to put on the table when you talk about being able to build out for the future? You know, leave us with 2 or 3 ideas that you would like to put on the table for all policymakers, regulators, the industry to consider at this point in time.
I think we need to see the opportunity which Uday Kotak got from 1985. How do we create such opportunities for many individuals and create an enterprise kind of creativity in the Indian financial services.
Well, Mr. Kotak, speaking of the opportunity that you got and the pitch and the wicket that you played at, let me ask you to end with a cricketing analogy. How would you like to describe your legacy? Would you see it as a Tendulkar innings, as a Kohli innings, as a Dravid innings? How would you like to be described?
Going forward, I mean, for me, the most important and memorable part of my career, not just the financial career, but my entire life, is the pride that Sachin Tendulkar's coach happened to be my coach well before it, Ramnath Achrekar. Okay? And therefore, please keep in mind, if there's anything I would like to do, it would be to nurture and develop and contribute for the long-term well-being of the Indian financial sector and the Indian economy in whatever role, particularly in the role of a coach, which I learnt at the feet of Ramnath Achrekar. Thank you.
So what next then, Mr. Kotak? What could this coaching avatar lend itself to be?
I think my view is that best way to think about the future is to plan nothing.
Well, I think that's a nice way of extricating yourself out of giving me a clear answer. But Uday Kotak, it's an absolute pleasure. Thank you very much for joining us here this evening. We wish you the very best of luck and appreciate your time. Thank you very much.
Thank you, Mr. Kotak. Thank you, Shireen, for that very engaging, candid, heartfelt, progressive and forward-looking conversation. Moving on, it is now time for the first panel of the day, $5 trillion economy and beyond, ambition to reality. India has now come out of the last economic down cycle as the GNPAs and the banking system have bottomed out to 24% of gross advances. Corporate India's balance sheets have never been so strong, and as Shireen also mentioned, bank balance sheets are also looking good and strong. India is well placed to start a new credit growth cycle. The pandemic and the recent geopolitical issues have only held it back a bit. To discuss how extensive use of technology could lead to better credit evaluation, commensurate governance, and how proactive monitoring can help reduce NPA formation, may I please invite Lata Venkatesh, Executive Editor, CNBC-TV18, to please come up on the stage for moderating this session. May I also invite her fellow panelists, just as the stage is getting set. May I invite on stage to join Lata, Mr. C.S. Shetty, MD, International Banking, Global Markets and Technology, State Bank of India. Put your hands together for Shyam Srinivasan, MD and CEO, Federal Bank. Prashant Kumar, MD and CEO, Yes Bank. And Mr. Ashu Kullar, CEO, Citibank India. Shyam Srinivasan will be joining us shortly. All right.
All right. I believe we will have Mr. Kullar join us very soon, expected any moment. But let's start off with what is very clearly the meat of the conversation today, the Banking Transformation Summit. How will the banking sector intermediate to make India into a 5 trillion economy and beyond? In fact, we've been a little more ambitious. We're going to say, how will the banking sector intermediate this India decade itself? So it's not just 5 trillion. We are not stopping there. Mr. Sethi, you actually represent, I think, 1/3 of the banking system. So the first question, or I think the brunt of the grilling will go to you. For starters, a large part, as the previous panel also discussed, a big challenge is going to be digital. And I think a previous banker, the Citibank head in the US, described it well when he said, I am basically a technology company with a banking license now. It's going to get as technology as that. Now, this is where the Google Pays and phone pays become a very big challenge. In practically a year or two, they've taken away a large part of the game. What do you think is the answer to ensure that it doesn't happen again? But more importantly, how does the banking system reply to this challenge? Are you all getting together to put out a common gateway? Because that 30% is available. NPCIL does want to restrict the others to 30%. Is there anything in the offing to grab that 30%? Oh, I'm sorry. Thank you, Ashu.
Thank you, Lata, for having me on the panel. I think when we talk about the big techs in the financial services space, we are essentially talking about the payments, right? They're not yet into other areas of banking. That may not be far away. We have to be prepared for that. Obviously, I think many of us have missed out on the payment space. We missed the bus. But today, if you see in terms of the volumes, banks like SBI, as a primary remitter bank, we handle a huge amount of transactions. While the intermediaries like TPAPs, what we call third-party payment application providers like Google Pay and all, of course, are the major participants in this. So what is required to be done? I think it's no point in actually revisiting on the payment space. Payment space is highly commoditized.
Do you lose data because it goes away to a Google or a phone pay?
So I think even as a remitter bank and the receiving bank, if you really talk about the data and our ability to utilize the data for building any models, it is still with the banks. That's what I feel. I think while the information which is flowing through the payment application providers are significant, if we have right analytical models, we have the data both as a remitter as well as receiving bank.
So you don't think you'll have, the Googles, the GPays have eaten your breakfast as
I don't think we are wanting to be there.
Okay.
And we have not missed out on any other thing if you really get it right.
Okay. Mr. Kumar, you want to add to this? This could be just the first chapter or the first attack. Is it possible that even lending could come more easily to the Amazons or the Googles or even local companies? Do you think banks will be able to first save their backbone before they start building India?
No, I think we should not see like in terms of somebody growing at the expense of others. Okay. I think we need to see in terms of there is a huge opportunity in the financial sector. Fundamentally, we see like fintechs and the NBFCs, they are able to grow because banks have not been able to take care of 1.4 billion population. Okay. And because of the kind of framework under which they are situated, the cost structure and other. I think what we need to actually encourage that if there are players who can use the technology and reach out to such a large population, how we can be partner in this. And during that journey, if we can also take certain initiatives, okay, and become the preferred player in that area. So I think today the opportunity lies, because the payment space is one part, though we are talking about these entities having say 70% market share, but I think also we need to see that who are supporting them in terms of technology. They are working on the framework of the technology being provided by the banks. Right? So what I am saying that ultimately the banks can also see the opportunity in terms of what can be done on the lending side. Okay? Though there is a huge issue in terms of data. But just like one example, when we say like data would be sitting with phone pays of the world kind of thing, but ultimately this data is sitting in the banks only. Movement is happening from one account to another account. So if there are say 50 crore accounts in a particular bank, you are having such a huge data. It's only about how you are going to use it.
Fine. So both of you feel confident that the fintechs are not taking away your business. Ashu, I'll let you catch your breath, and let me first get Shyam Srinivasan in. He's joining us remotely because of a personal problem. Shyam, you think banks are safe? I mean, before I ask what banks can do for the country, I'm asking for banking survival itself. Do you think that banks don't have to worry about fintechs? RBI is there after all.
No, see, I think that's the point I heard both Sethi and Kumar speak. I don't believe it's a matter of threat or survival or any such thing. First, please understand the revenue pools where they are sitting, right? There's lending revenue pools, there's transaction data revenue pools, and there is liability or deposit revenue pools. So, by the fact that an intermediary or a payment company has the access to transaction and payments doesn't automatically mean that they are conquering all the revenue pools. So to believe that the banks will have a challenge, and it will sort of threaten their existence is probably misplaced. Many years ago, when the UPI-related conversations started, there were similar conversations like, would this be the end of banking? So I would think that in short, this will coexist. Like Mr. Prashant Kumar mentioned, the data is seen by the banks, and I don't believe banks are in any form threatened by this. Yes, the data and mining of data and use of that data depends on the smarts each organization has. So I am not perturbed that and we are a bank that works very closely with fintechs and understand quite deeply how it has to be a very collaborative, symbiotic experience as opposed to somebody conquering the whole space. So I am quite convinced that revenue pools for banking are larger than just transactions.
Okay. So, well, all of you are confident that fintechs are not taking away banks' business, that they are merely enablers in a space where you anyway don't want to be. That's fine. Let me come to another point. I was speaking about the Citibank, I forget his name, but the quote that I'm really a technology company with a banking license. There's that much of technology needed. In that context, Ashu, do you think as banks intermediate India into a 5 trillion or a 10 trillion economy, do you think one of the biggest challenges is manpower? The headlines hitting the day today is 30% turnover, 30% attrition in the banking system, and some of them at the lower levels, it's 50% attrition. At the lower level, and probably it goes up to 20% when you come to the middle level. Do you think manpower HR is going to be a very big challenge?
I actually see it as an opportunity. In fact, the whole world is looking upon India as a talent source, and I think the whole...
That will make your challenge even worse, wouldn't it?
Yeah, there is competition, of course, right? But the point I was trying to make is I think some of the attrition rates have gone up and down depending on the competition from some of the tech players, but that is now moderating. At least the numbers this year are far, they are more like 10 to 12%. There may be certain segments where you see more. That obviously puts more pressure on banks to be competitive in terms of, what growth opportunities, what compensation, and it's not only compensation, by the way, it's what culture you give them. But I think, again, we have to keep it in perspective, and that's where I'm coming back. I think the talent pool availability in India in terms of size and quality is a great asset to India. Now, yes, would you be competing with more players? Absolutely, right? But that's business, no? You compete for clients, you compete for people. But I don't think we have any supply shortage of good people.
You would agree, Mr. Kumar, because, is this that banking system is not getting its HR right, that we are speaking about 50% attrition, or is this a leapfrogging of financialization in India? More demat accounts, a huge growth in demat accounts, so payment companies want your talent, fintechs want your talent, mutual funds, that industry has grown, insurance companies. So do you think this is a challenge that's going to stay with you?
So I would slightly differ with Ashu in terms of that we are fortunate to have a huge supply of the talent available. I think at least our understanding is there is a shortage of the right kind of skill sets. Okay? Because ultimately this attrition, what we are seeing, people are moving from one bank to another bank. When the private sector banks or the public sector banks are expanding, and I would differentiate or segregate between the private and public,
Because most of the movement is happening between the different private sector banks. There is a shortage. When the banks are expanding, they are looking for the experienced people. And when they are looking for experienced people, the people who are working in a particular bank, if they are finding it attractive in terms of maybe a career progression, location, or maybe a compensation, they try to move there. And in private sector especially, I would be saying life is difficult. It's more challenging as compared to be in a public sector bank because of the kind of demands. The same business which you want to do in a public sector bank, I think you have to work 3-4 times in getting the same kind of business in a private sector. So life is very, very difficult, very demanding. And I think when the youngsters are not able to deliver on those things, and because of the kind of today, I would be saying because of the social media, and you always get greener side on the other side. You always try to see.
You have been in SBI for a better part of your life. So I'm asking you, is it the private banks are getting something wrong? That's the attrition is more their problem,
I think
Mr. Setty's problem.
No, it's about, I was also heading the HR in SBI. Okay? I would be giving you an honest answer.
It's not a SBI problem, is it? Is it more a private sector problem?
I think if you're finished with Prashant, I want to continue what Prashant has said.
Okay, let Mr. Prashant Kumar finish your point.
So what I am saying, there are different set of people, okay, who would be looking for the career in the public sector banks. Okay. So I think there are those people like who would like to see that stability, who feel pride in having those kind of the positions in public sector. So I think that was a different time.
No, I think I want to get you back on the worry that I have. Is there a talent problem? Because that's related to my first question. The business is being taken away, if it is payment business, because Google had some kind of talent. Now, would talent be such an issue? Because you will all be technology companies. So can it become a constraint, Mr. Sethi?
See, I think in another forum where Mr. Srinivasan and I was there, the same question you asked in terms of, what are the major risks which the banks are facing. Instead of saying that it's talent crunch, I think the biggest challenge is talent management. I think most of us feel that we are not investing enough in keeping them. In a way, I think public sector banks have got it right in terms of the talent management. I'll tell you.
Mr. Kumar
Mr. Kumar is saying, though I differ in what Prashant has said. Prashant, in the last 3 years, it has become difficult for the public sector banks also to get the business. Okay, let me tell you, it's not easy. But then how the attrition rates are much lower for public sector banks is that there are 2-3 reasons. One is, of course, a lot of people talk about job security. I don't think in the junior management they're really worried about job security. You start talking about the job security after 10 years into your job, not initially. I think public sector provides a lot of variety of your job profile. Most of the private sector banks, in terms of job families, in terms of specialization, domain expertise, they expect them to continue for longer time. I think that is what actually creating people.
It is an HR issue.
Is an HR issue, and people have the change happens only when they change an organization. That's how the attrition rates tend to be higher in private sector and lower in public sector, because for us every 3 years we have a new job, right? So, but having said that, I think it's also important that we need to create among the youth who are joining. You're right. I think most of us have today. If I take 2,000 probationary officers, which is the entry-level officers for SBI, 92% of them are engineers. So how do I create a sense of purpose for them? If they're coming with an engineering background, I'm trying to make them a banker. We have to first tell them that, what is banking job all about? I think most of us failing in terms of if attrition rates are higher, we are not reorienting them to the job what we are trying to give to them. I think it's the biggest challenge.
It may be a reward now because you want only electronics
engineers.
Exactly.
So we have seen that, I don't need to probably recruit specialists going forward. Okay. I have an engineer who gets trained in the banking and he can be a better technocrat for me.
Okay. Yeah. All right, the final, I just want to put an end to this because my sense is that there is a definitional or there is an existential challenge for banks all over the world coming from technology and from digitization. And therefore, Shyam, just to wind up this question, do you think that will be a challenge for the Indian banking system to mediate India to a $5 trillion economy? Getting the right people because there's so much competition for the same kind of talent.
I think this attrition thing to some extent is overblown because there are different job families and you're seeing the attrition at the lower end, probably who are front end and sales focused. Our bank, we are private sector, right? Owned by private sector, has some public sector bank characteristics historically. Our attrition is 3%, right? So I don't believe it's a universal problem. It's probably specific to particular job families and therefore it cannot be something that we can amplify. That said, I think the definition of what Mr. Sethi said, I totally agree, is how do you keep them motivated, offer job rotation consistently and skilling. To that extent, whether he joins Federal or SBI or Yes or Citi, it's not, I think, an entry point, more or less everything is the same. It's only how you are schooling them through the period, rotating them to opportunities. And yes, there are reward mechanisms now are normally with RBI insisting that the reward program for most banks are fairly programmed in terms of how much is variable, how much is fixed. I don't believe that competition is going to be such a massive difference that it will take away people from one to the other. Then it's the experience, the opportunity to learn and exposure. I think HR processes of banks that does that better certainly will see lower attrition. And this attrition at 30, 40, 50% that's being talked about, and I think it's going in currency in the more recent quarters, is probably a little definitional. Some jobs in some organizations in the front end see higher attrition, but I think middle and senior management, you're not seeing that. They're moving within the banking system. So I don't think banking sector is going to struggle for talent. Okay. Banks may, but not the sector.
Okay, fair enough. If that's not such a big issue, there is an existential challenge in terms of being able to tackle digitization. So I just want to know whether you all think that's a serious problem. You wanted to add to it, Ashu?
I think it's very specific to each institution, and I don't personally see people as an existential issue.
Okay. Fine, then let me go to, instead of looking at challenges for banks, to what extent can banks intermediate or are they prepared to intermediate the India decade, as it were? And there the big question, Mr. Sethi, is infrastructure. At the moment, everyone is in retail. No one's talking about big infra projects, and when it comes, will you have the appetite? Will the banking sector have the appetite or even the balance sheet? For long-term money.
I think when we had so-called twin balance sheet problem, obviously when the credit growth had come mainly from the retail. And the consumption patterns also have encouraged and easy. And also, see, let me tell you, digitalization also had helped in growing the retail book. Today, any retail lending operations are expensive, operationally expensive, right? To distribute 100 crore worth home loans is extremely difficult than
writing 100 crore check to one company.
But the digitalization and technology definitely had helped us to scale up the retail. And today we keep saying that we do our pre-approved personal loan in 3 seconds on our app, and the volumes can be tremendously built up there. So I think the ease of delivering the credit and also the demand for credit has definitely increased the retail. What is the ideal ratio for any bank to have? Is it, we were 40-60, in the sense 40 retail and 60 corporate at one point of time. Today we are 60-40.
No, the point is, the entire banking sector kind of paid the price for its fascination with infrastructure from, say, 2005 to 2015. So have you all gotten so scared away that, you would, and retail is so much more easier and risks relatively distributed. Will there be a challenge from the banking sector to even fund infrastructure?
So definitely the retail lending is attractive for everyone, whether large banks or small banks, NBFCs, MFIs, everybody is going into the retail. when we talk about retail, it is not pure play personal retail, it even MSME, all that gets added to that. So if you talk about infrastructure, I think let's also look at the numbers. I think anecdotally everybody is saying that no infrastructure funding is happening in the country. If you see 21-22, there were 930 projects which were announced by the private companies, right? Which is almost 2.6 lakh crore commitments. And if 22-23, if you say, I think the numbers almost pan out on the same level. So this investment aspirations are going to get released in 23-24. We expect that if you take SBI alone, we have said that our pipeline of infrastructure is almost 1.6 trillion. So I think, well, whether it will be again a public sector bank driven infrastructure financing or private sector and public sector together, we'll have to see. But one thing what we have learned in the last NPS cycle is that what needs to be done right. I think infrastructure financing has taught many elements in terms of, before you underwrite. One is if you have to
first get the land.
And right of way. Right of way is a big issue, right? And also the permissions. Today,
so you think the banking system is wiser?
We have more wiser, and we have strengthened our underwriting standards, number one. Number two, I think a lot of principal agencies also have realized that the banks will not lend unless I take these steps. NHI today is assuring us 90% right of way before I give the road project. I think we are poised. We have learned our lessons. We have tightened our underwriting standards. And we also are able to say no to a project if we are not satisfied.
My fear is you are saying no to too many projects.
No, not necessarily. See, I think if it is so, then, I can't be talking about 1.6 lakh pipeline which is with us. So some sectors will take some time to come back. Today, the renewables are doing well, roads and highways are doing well. So obviously, the lot of infrastructure financing will go into it. So sooner or later, I think most of the banks will find it attractive to invest in infrastructure, and most of the core sectors also are probably would attract the debt capital, in my view. And the last piece I want to say on the infrastructure financing, why the banks will be interested is, there is some element of visibility of takeout financing now available in terms of the InvITs, in terms of the REITs. So those structures were not available earlier. I think definitely the environment is congenial for getting into the infrastructure finance.
Okay, Ashu, I want to get you in that. Is foreign capital ready to finance Indian infrastructure? Is the capital market ready to finance? We don't see debt market of any kind. I mean, we only have a GSEC market. And we have a bit of an NBFC, probably a bit of a CD market, and an NBFC bond market. Is the capital market ready to finance?
Yeah, so if I can just frame this, Lata, I think if India has to meet our growth aspirations and kind of given the stage of development we are in, I think we need to increase the spend on infrastructure from the current 5 to 6% of GDP to more like 9 to 10% over a period of time. Most of the investment till recently has been public sector or state driven. Private sector needs to kick in. So the demands are going to be immense. In my view, bank lending is not going to be enough to meet that needs. Loans is not going to be enough. Domestic supply of capital is not going to be enough, which means we need to kick in, and you mentioned, sir, about takeout financing from. So you need more investors coming through, and I think the fact that REITs and InvITs have started to get good response, I think is a great start. We've had a number of recent highways, REITs, and I think you want to see more of those pension funds, sovereign wealth funds, infra funds coming through. A lot will become about risk allocation. Frankly, in my view, banks should be focused to take pre-completion risk. And post-completion, as Mr. Shetty, you said, you should be trying to term it out in the capital markets, which is the model which has worked wonderfully well in the US and Latin America. Because banks should not idly be putting on 15, 20-year assets on their balance sheet. That's not what their funding model is designed to do. So I think till we can get a lot more players in, can we get the right risk allocation? And the last point I want to make is, I don't think we should think of banks only as lenders to infrastructure. We should think of banks as providing credit enhancement in some cases, whether it's pre-completion or some other portions of risk allocation. We should be thinking of them as underwriters and arrangers. Because see, one of the things for us as a foreign bank, for example, is always looking at an arranger underwriting role rather than just putting big money on the balance sheet. Now, there are certain players who have an ability, like Japanese banks traditionally and French banks have been traditionally big players, but I don't think the needs are going to be so vast. Everybody needs to kick in. And a lot more work, in my view, needs to be done before we get anywhere close to meeting the kind of needs we'll have for financing infrastructure.
Need to be done in the legal sphere.
Legal, structural, more players, and I think ultimately it's about risk allocation and issues about, obviously we've learned from the experience from the last, the project financing wave, and that helps, but we just don't have enough tools right now to meet the need if India has to meet its growth aspirations.
Exactly. The projects put out by the NIP, the National Investment Pipeline, was, 100 trillion rupees. We are nowhere, getting close to climbing on that figure. And so let me continue the conversation with Shyam. Shyam, the point that everyone is raising is risk allocation, or that we don't repeat the mistakes of the previous time. PPA is not signed. Coal link suddenly not available. Force major clauses perhaps not in. Land not acquired. If you looked at the performance of the IBC, it is hardly encouraging. Came with very good intention, but barring steel and maybe one cement company, which are both manufacturing entities, infrastructure power was hardly restored. We missed Mr. Rajneesh Kumar over here, but he ran from pillar to post trying to put those Samadhan projects in, but hardly anything could be recovered, in the period. Are you, are you satisfied or confident that we are prepared for the next infrastructure cycle at all in this country? No, I think you're on mute.
No, I am not. Can you hear me?
Yes, please go ahead.
No, I think there are two realities, I said. First is that we need the massive growth and investment in infrastructure as a given. And that's going to happen. And we're seeing, like Mr. Sethi pointed out, even in FY24, the one that we are sitting in the first few months of this year, we've seen more proposals coming in than I think the greater part of last year. So there is.
Did you sign on them? Did you accept those proposals?
See, I think that I'll go to Ashu's point. Banks are not entirely into signing off on 15-20-year credits, right? So we have to be quite thoughtful about it. But the first point I was going to make is there is active demand, and it is beginning to show up, and banks are getting projects. Depending on each fund's funding, balance sheet capability, you will take on risks, and that is already happening. Now, is everybody sort of panicking that, oh God, the recovery mechanisms are not in place, and therefore we will not? I would go back to what Mr. Sethi said. A lot has been learned, and a lot has been put in place at this point in time, to the extent that I don't think those are sort of stopping us from doing what we have to do to support these projects, and in particular, projects that are seeing good traction given where we are. I think the NHAI projects, the hybrid ones, we are seeing action. We, as a much smaller bank and a much smaller balance sheet, are willing to take that risk. A year back, 2 years back, we were not doing that. And so to that extent, there is active work going on and willingness to take on risks. We are also seeing that the ability to need to face an IBC kind of situation is well addressed upfront. They are able to get structures that are more in support of going ahead with this. And I think when Sethi said NHAI is giving almost 90% protection, these are fundamentally game-changing, I would think. And I'm sure that the next wave of growth, in all credit, and in particular the high-ticket, long-term financing, you're not going to see the amplitude of the problem as what you saw. In fact, the good news is India of 23 and 25 and 28 and 2030 is not India of 4, 5, 7, 10, right? We've seen a lot more data, a lot more analytics, a lot more information, a lot more organized structures around it, which will support growth, which we are seeing already. And the level of information available, and for the bona fide customer to go astray, the opportunities are very limited. Unless it's a fraud, that's a different story. But if he's a bona fide borrower, irrespective whether it's corporate, retail, individual, commercial, SME, I think the infrastructure in the country has made sure that you can't go hugely astray because
I
you
take
want
your
to be
point entirely on retail credit or maybe even MSME credit. But I'm not still very sure that if the next infrastructure cycle went bad, we have the institutions to recover money. Are you feeling that confident, Mr. Prashant Kumar? There are some, 6 lakh or is it 6 crore cases that are pending before the lower courts for the last 50 years. I mean, the legal system is a mess. So if you have to take the IBC process through the courts, are you confident, or is that the next homework that we have to do now that the times are good?
No, I think if you are talking about the IBC process in terms of the infrastructure, okay, or if you are talking about the IBC...
Roads is maybe still corrected, but power, I mean, generally infrastructure, I don't think the IBC process has delivered, has it?
No, so issue is in terms of like IBC, with what intent you are going there. If you are going with the intent of only recoveries, okay, and that too you are going after a long period, and where the IBC itself would take a time even for admission of the case. Exactly. 2-3 years, and then there are legal issues in terms of...
They were supposed to admit immediately, and they were supposed to settle it in 120 days, going maximum to 270 days. I think the average is running at 600 days.
No, absolutely. I think if we see in terms of the success of the IBC process, what you have rightly said, barring 2-3 exceptional cases, I think the recovery percentage have been very, very small. But I think we need to see the background, the entire thing. Those cases which has gone to IBC, they have been declared as a NPA after a very long time. There were multiple lenders. It means the decision making within the lender was also a problem. And ultimately, the IBC is being run through the established NCLT process. I think why can't we have the separate NCLTs only for IBC?
Yeah, I guess we have to get the bandwidth for that. But very quickly, just to wind up that question, it's true that, you know, when the IBC came, it already had a backlog of cases. Now it will only get incremental cases. You also have CRILIC, where, you know, the default has to be immediately reported now, and maybe cases will not, become very mature and bad. You think, therefore, the next cycle won't be so vicious?
Yeah, I think just to answer your question, I think it's your favorite question that, why IBC is not delivering today. I think early successes also have built up the expectations from these relatively new, legislation. But having said that, the institutional capacity has to be strengthened. I think that's very much required, both in terms of the number of members, number of benches. I think government is working seriously on that. As Prashant says, admission is the critical process, and then we'll take it forward. But the offshoot of the whole insolvency process in the country is that today, when we are underwriting, when we are structuring a loan, we are actually keeping what can go when you go to the IBC, what can go wrong, or how do we prevent a loan actually going to the insolvency. This is a major, major benefit of that. In fact, I always tell my underwriters is that earlier our documentation was just a documentation, it's a paper, right? Today every covenant, every structure, every security package is designed in a manner that, what happens when I go to the IBC process. Because these were not there, it had led to a lot of litigation, a lot of, discord among the COC members. You had first charge, second charge, there were fourth charge, fifth charges also. Yes. So all these structures are now understood in a better manner. I think that way, apart from Krilsi, what you mentioned in terms of, better monitoring of what is happening in the credit, the structures itself have enabled in a manner that probably we don't have to go to IBC at all.
So better contracts have been written, better covenants have been written, and so hopefully we won't go through such an ugly cycle. Maybe roads, even as you say, NHA has moved with sufficient caution. I mean, I don't think you can blame the ills of the legal system on the banking system. So perhaps we have to keep our fingers crossed about the next cycle not coming. Just for those of you, I mean, I think all of you are bankers, but the CRILC or the CRILIC he referred to is the database which the Reserve Bank has, and the first default, delay in payment by any entity has to be reported to the Reserve Bank that Friday. So hopefully, you can't go bank shopping default with one and take from another because the system now is more aware. Hopefully it will not be that bad. But now let me come to exactly the other side of the issue. From infrastructure to retail, India is still a seriously underbanked country. I mean, for all the Jan Dhan accounts that we have, it is still only an account, and even that I think is what, 80% or 85%. And over there, it's not as if everyone has credit. So, Mr. Sethi, to start with you on that, do you think banks have the wherewithal, or if you want to expand it to the financial system, banks plus MFIs plus NBFCs plus fintechs, are you geared as we go towards a 5 trillion and a 10 trillion economy to service the last man in terms of loans?
Yeah, I think it cannot be done only by the mainstream banks. That is established. Because one is, of course, the cost structure. And number two is that the last mile connectivity is still an issue. Despite having the largest branch network, we still feel that we are not able to really reach the... So it's a combination of the mainstream banks with capital providers. And then you have NBFCs, MFIs. I think the whole ecosystem has to work. And the concept of funding a thin file customer, the usual word which they use, as we are borrowing from the NBFCs and MFIs, honestly, and how do you finance a thin file customer is data driven essentially.
Sorry?
Data driven, today even on the Prime Minister Jan Dhan accounts where we have almost 16 to 17 crores of such accounts, we have adequate data to understand. It is not only about, a lot of people think that, Jan Dhan accounts get only DBT kind of credits and what is that you can lend to them. Out of 15, 16 crores Jan Dhan accounts we have, just about 3 to 4 crores probably get the DBT. The rest of them are very active. There are Jan Dhan accounts which have got an average balance of 1 lakh rupees. So we have the data, and if I'm not able to deliver to them, I can always use the co-lending models, which is again another concept, which is quite useful. We have to get it right. The technology would enable us. So in terms of reaching the last mile, a combination of mainstream banks, NBFCs, MFIs, backed by the data and the capital provided by the mainstream banks is quite useful, I suppose.
Okay. You want to add to that, Mr. Kumar? Do you think retail banking is set to take off in a big way? I mean, everybody is in retail, but there is still a large unserviced category which needs to be financed if we have to reach 10 trillion with all guns blazing. Is that in place in the system as a whole, not just banks?
No, I think as a system, like what Mr. Shetty is saying, if everybody together is moving in that direction, I think it is still some time away. Even if we see like banks, NBFCs and MFIs, I think it's a very large country and such population. But I think we are moving in the right direction.
Okay.
With the use of technology, especially by even the MFIs and the fintechs and the NBFCs. And then coming out with the products, coming out in terms of using the analytics. Because ultimately, giving the loan is the easiest thing. Getting the loan back is something which is important. So I think once we give a loan and everybody understand that we would be able to recover it, I think it is good for both customer as well as for the banks.
Okay. To Shyam, I'm going to put the question on its head. Shyam, if we're going great guns as far as retail growth is concerned, banks are moving from probably 35-40% public sector banks, retail, to now well over 50, some of them even 60-65, and private sector banks are already at 65% retail credit. What if the cycle turns? Are we, unsecured credit, I think already the Reserve Bank has raised that red flag. One economic downturn can lead to a lot of issues in terms of collecting. As Mr. Kumar says, collecting is always more difficult than giving. Do you think we are prepared for that? Are we heading into a likely problem on retail credit?
In another conversation with you a few days ago, I explained the situation. Let me repeat myself. I think, will there be some cycles? Absolutely, yes. All right. Is that cycle upon us right now? I don't believe so. Second, even if the cycle were to arrive, we must understand the level of bad cannot be what it was in the past, only because of the reasons we spoke while ago in terms of the architecture of the ecosystem of banking today is materially different than it ever was. You know, we all leave digital footprints all around us, and it's something that you and I cannot escape. So that data, banks, financial institutions, and BFPs, whoever they are very thoughtfully mining it to make the best sense of it. So unless, and I keep repeating always, unless the intention is to defraud the system, a bona fide borrower today is most keen to honor his commitment and pay. So if you take the last 25 years of Indian banking and look at it, which you've done all the while, the amplitude of credit bad has started coming down from 20% NPA to 10 to 3.9, likely to go to 3.5. The worst case now it can go to 5%, 5.5%. It's not going to go back to 10%. We will all be asleep at the wheel to let that happen. So I think we can be quite sure that the Indian banking system is in a place where the level of bad will not be what it ever was. That's one is given for the reasons I mentioned in terms of the ecosystem, the development of technology, the smarts that people have developed to ensure that you are well insulated. Second, I think our belief that unsecured is equal to necessarily bad is actually beginning to get challenged, because the unsecured borrower, particularly the younger, newer borrowers, don't want an impaired credit history. If you see in the recent past, the unsecured behavior popping up to some extent, it's not the existing customers of banks that are causing this problem. It could be the exuberant lending at the bottom end whom we are trying to bring it into the system, and there's a good chance that they are repairing their credit history once the collection process is upon them. So I don't think you will see bad rates as high as it was. Yes, will there be some sort of uptick given the if there's a slowdown in the environment, you may see that, but I am reasonably convinced that the level of that will be way lower for the reasons that we've all been talking about. But I'll just go back to one point when you asked the earlier question on credit to the bottom end of the pyramid. I have to say, Lata, the digital lending, and you probably are aware that we're doing Kisan credit cards using digital technology, along with RBI hedge. It's a farmer loan, right? 1.6 lakhs. It's in 5 seconds. 5 minutes. That's all it takes. And that at scale is going to change quite materially. It can be 20, 30,000 crores credit opportunity for farmers and dairy farmers and, paddy farmers, a range of them. A bank of our size, we are seeing scale. And I can't quite imagine what it will be like when SBI or somebody were unleashed. So for sure, that's going to be a great bottom of the pyramid, a credit expansion opportunity. I'm seeing that already happen. And coming back to your point on retail bad, I would think it will be way lower than it ever was. Will there be an uptick? Yes. But I think the smart system, the ecosystem ability to catch early, detect early is improved materially. I don't think it will deteriorate to the extent that we saw, say, even 3, 4, 5 years ago.
Okay. Well, I would say, aapke muh mein ghee shakkar, but we will know only when the cycle actually comes. There are several banks that are even banks, NBFCs, fintechs who are new to retail as well. So we have to see a cycle before we can be as sure. Yes, perhaps the next cycle will not be as bad as the previous because we have put in some defenses. Okay, now, last round of 2 rounds of questions, and it will be the same question to all of you. Ashu, I start with you. What keeps you up at night, if at all, about the banking system? What's the big threat that, or 1 or 2 big threats that we should be wary of?
Yeah, and I think it's something which we think about a lot. And I think one thing I say, I don't think we worry so much about the credit losses in the system for all the reasons which have been mentioned. The banks are much better capitalized, the data. I think I don't really worry so much about it. What I worry about is given the extent of automation, digitization, real-time processing which is happening, which has a great positive side to it. We all know about it. But the converse of that is if there is an operational resilience issue, downtime, cyber attacks, then you're going to be a lot more susceptible. And I think we saw an interesting spin on that in the SVB situation where the run on the bank was a different kind. And I think it's those kind of things. And the problem with cyber security, especially so, is we all invest a lot and we think we are kind of ahead of the game. But I think that's the thing which nobody has a handle. There's so many rogue players, state-sponsored players, whose technical abilities are as good perhaps as whatever the banks have an ability to put out. So I think to me, That is perhaps the most significant thing I worry about.
Cyber risk, I mean, Mr. Kumar, is that also the biggest risk? Anything else that we should be worried about on the banking system?
No, I think in addition to definitely the risk on the technology side, which are being faced by the individual customer as well as a financial institution. Both of them are facing. I think one of the worries in terms of that at no point of time we should move into a complacency stage. Because ultimately all of us are human beings and there is an inherent desire to grow. And we somehow start believing that we cannot make mistakes. I think that can be a very, very serious problem. And all these problems normally happens in good times. So I think it's very, very important to continuously remind us that we are a financial institution. We are also continuously, because of the ecosystem is changing, we really don't know sometimes. If you see currently there are certain international events. Okay, nobody was expecting those kind of things. Nobody was expecting that we would be living under such a high inflation across the globe. Okay, maybe this would become a normal. But I think these are some of those challenges which as a banking institution we should always be worried about.
Yeah, you can't be complacent. Tim Cook or Sundar Pichai may eat away your meal, I agree. Mr. Sethi, you want to add to the things that worry you?
I can only rephrase what Ashu and Prashant have said. I'm also in charge of technology in the bank, so the largest bank of the country. Obviously, the cyber risk, I think two things I would like to say. One is about the interconnectedness, both in terms of the technology and in terms of the global financial system. Both are actually, will definitely keep us sleepless, which we have seen. The technological interconnectedness, when we talk about it, the whole ecosystem of vendors, customers, technology providers, banks, have created, a huge attack surface and also the huge perimeter to defend. And as Ashu says, it's very difficult to say that, I've got it right. Nobody can really say that, where the next challenge is coming from. I think it's not only protecting us, it is also protecting our customers, which has become an extremely important task. When we talk about the global interconnectedness, I think it's more in terms of every global event has an impact on the Indian banking and financial system. I think we are so much, we talked about decoupling. I don't think really we decoupled in a real sense. So I think these two interconnectedness are the ones which are actually keep us, completely disconnected from our sleep.
Oh, absolutely. I take your point. Shyam, you want to add to anything that the banking system should be wary about?
When you're the fourth to answer, mine is all 3 plus a few more, right? Okay. One is, just the fact of relevance. Can we be just become irrelevant? So, and the second is massively operational. All this great strategy, all this dialogue keeps going on, but anywhere somebody moves up. Because one thing, remember, as we get more and more digital and more younger workforce, they've never passed a physical entry. They're clicking keys. So nobody knows what goes behind the box.
Sorry, right? They have never passed I didn't get you.
They have never passed a book entry. They have never passed an entry in a book. Right? So the world of, it's a black box. So I always worry that the operational risk of not knowing what happens behind that black box can lull you to believing the system is taking care of it. So that is my operational risk, and of course risk of being irrelevant very soon.
As the digitization process takes us further and further away from the real transaction, and we only know the digital transaction, yes, the operation risk continues. Okay, the last set of questions is asks from the system, from the regulator or the government. Anything that comes to the mind, foremost, Mr. Sethi?
I think I just would like to borrow something what Mr. Kotak had mentioned in terms of the phenomenal work the regulator has done during the last 3-4 years in terms of handling the COVID and all. So this period also had helped in terms of the regulator focusing on the technological resiliency, operational excellence, and compliance. I think in a way, the banking system is strengthened. I don't think we can ask specifically, but if you insist, I would definitely want to ask one thing. Is that when we are talking about the 5 trillion economy, there will be new set of industries, new set of activities which come into picture. Today, one of the things which we keep requesting both the government and the regulators are that whether new set of activities can be brought under the priority sector. This is very important because one is it gives fillip to these many of these activities, particularly in the startup world. And number two is that it will also enhance our ability. See, today, if you are growing on the retail space, of course, your commitment for PSL also is tremendously going. And unless you add more and more new activities to it, achieving the PSL...
Mr. Kotak was saying priority sector itself needs to be reduced because it's making us uncompetitive vis-a-vis NBFCs.
I will go next round of discussion when I come back, I'll ask that. But for the time being, I would like to have more
shuffling of the
sectors to be added to the PSL.
Fair enough. What would be your ask?
I think three things. First, I think both government and Reserve Bank, if they continue to support the way they have done for the last 4 or 5 years, I think that is very, very important.
Okay.
The second would be in terms of, I think, the real improvement in our recovery processes. Because the recovery process is
not good enough.
Not good enough, whether we talk about the IBC or the legal process. I think there is a huge requirement to streamline this part. And the third is definitely in terms of the priority sector. I am not saying like we reduce the overall, but I think we are creating so many subcategories within the overall priority sector where banks would be finding it very, very difficult. And ultimately, who is impacted? If the banks are not able to make money, it's ultimately the common person or the depositor who are impacted. So maybe because this is the requirement of the country, we can keep an overall part, but not in the subcategories on the priority sector.
Yeah, Ashu, I want you to wear a fintech's hat and answer what they are saying. The regulator and the government have done a great job of protecting banks. In the process, not putting a moat for fintechs not to attack the banks. Do you think rules are stifling innovation and they need to change?
You're putting me in a very difficult situation, right? It's not a fair question.
No, go ahead with what you ask, but I'm just wondering, since they are feeling so happy about the regulators, is he getting something wrong?
Well, I think the fact is, I think the banks do get the benefit of the regulated industry, right? And frankly, I think it's right. Because
yes,
ultimately,
they're protecting my money, I'm
protect
very happy about it.
The depositors, because it's not like, okay, just let's disrupt away and innovate away without any consequences, right? So I think, therefore, yes, it's true the banks have a degree of regulatory protection, but I think there's a reason. And not having that could also lead to chaos, while it may stifle certain bit of innovation. So I think it's a balance which regulators have done. And by the way...
Would your ask be, give me more branch licenses to foreign banks?
Well, frankly, in our new model, I don't think branches are that relevant for us. We are where we need to be. I think we are okay. I think overall they've done a great job, to be fair. I think what I wonder sometimes is, again, this is in terms of aspirationally, are we ready for a $5 billion, $10 trillion economy? And I think, do we still have enough banks for for an economy of that size? Would at some stage, with the right protections and balances...
Do we have enough capital?
Do we have enough capital? Do we have within capital? I personally don't worry we'll have enough capital to fund corporates and retails. I worry in infrastructure space. Do we have the enabling legal, contractual risk allocation framework? I believe we do not. There's a lot more work needs to be done. And then ultimately, I think the plain fact is India's domestic savings are not enough to meet our growth aspirations. And do we have enough of an environment for foreign capital to flow through? And of course, there's an FDI where we have an opportunity, but more relevant to banks or financing is on the foreign institutional side. And again, bond index at some point, I think it's a question of when, not if. That's a big enabler. But there are elements which I think need to be addressed if you really need to get to our meaningful ambition to be a 5 trillion economy pretty soon. And to be the third largest economy, hopefully by 27 or 28. It'll happen. It's a question of number of years.
Oh, absolutely. That's on the cards. Shyam, your ask, and I'm wondering why I didn't get that from the other two bankers. Maybe my thinking is wrong. See, when the Adanis bought the cement companies, none of the banks could finance it because takeover financing is not allowed. They had to take foreign money. A ripe fruit was not available for the Indian banks. You think those rules need to change? You should be allowed to finance takeovers? You're on mute.
Can you hear me?
Yeah, go ahead. Go ahead, we can.
No, before I answer that, Lata, I think the question you asked, some of them, I hope I'm not misinterpreted, but I believe the collaboration between fintechs and banks is probably less understood. And sometimes innovation happens at the fringes of regulation, right? That's how it works. Where you control, where you let go is always the challenge. And I say that because we work very closely with fintechs, and there is always that nervousness, are we stepping over and going to get into trouble. But I think a better appreciation of that will help to inclusion, spread the credit expansion, get customers from unbanked categories into banking system. I think there's a huge opportunity. So if you ask me for an ask of the regulator, I would encourage more dialogues around how do you make sure that what looks like an adventure is actually allowed, but within a boxed environment, and then you can scale it up. So that's
they allow sandboxes.
Yes, they do. Yes, they do. But I think what happens in all these things is that there are some silos that do, but whether it breaks or whether it overrules some existing regulations needs some more thinking around it. Now, when I say these things, one has to be careful because it can be misinterpreted, but I think the message is very clear. We have to do more in that space to ensure that it can truly be expansionary.
Well, I think a fintech is missing in this panel, and they will perhaps have much more in terms of regulatory asks, and my sense is the next conversation will take that action forward. We've had an extremely interesting conversation. Bankers largely confident that they will be able to intermediate India into a 5 trillion, a 10 trillion economy, that they'll be able to intermediate into the India decade, but worries on whether have we solved the IBC process. Is the legal system still ready to help the bankers get their money back when it comes to the crunch? Those problems remain, and whether we'll be able to intermediate the next digital wave very well. Those dialogues are still very open. I don't think we have time for too many questions, but certainly a couple. Yes. Can we get the mic there, please? May I request you to keep the question brief because the next speaker is ready.
Yeah. Thank you. So my question is to all the panel members. It's a common question. So how does ARCs have performed, whether they have fulfilled the objectives on which they were formed? The related question actually is whether they have capability to price the infra loans based on the risk, the operational as well as under construction.
Okay.
The third related question actually is on the ARC itself. Okay. Is does the SPV structures are proving to be a hindrance for ARCs to price as well as IBCs to provide a smoother judiciary process?
I think this will require a panel in itself, but Mr. Sethi.
Exactly. I think it's, as you said, we should have another panel for that. But I think whenever we evaluate the success of ARCs, we have to see the evolution of the ARCs mechanism. See, in the initial stage of 2013 to 14, if you really see, all of us have sold the asset to ARC for our own balance sheet management. I don't think really
expected them to reconstruct.
So reconstruction, recovery and all. Obviously, they also lack the institutional legal mechanism to do that. But what I see in the last 3-4 years when we moved, and also the 1585 structures and all have not been really successful. So today, I think ARCs evaluate an asset because they evaluate more stringently because they have to shell out the money upfront. I think to that extent, in my view, it's a much better system now. And a combination of my own ability to enforce the security and also if any delays are there to use the ARC mechanism is a better combination, I feel.
Okay. Mr. Prashant Kumar obviously has made money on ARCs. Just now a 230 crore check has hit Yes Bank. But something more is on the way, I believe. Give us a headline. Is it something coming from JC Flowers?
No, I think what we are disclosing to stock exchange, if it is more than 10% of our last year profit,
okay.
The other recoveries,
you're not disclosing.
No need to disclose.
So it's more than 230 that's hit the till. Yeah. I think it will have to be the last question. Please go ahead. The mic will come to you, so 1 minute.
I have no question for the panel. I just wanted to update everybody that we are about 100 meters away and we are about to land. It's a golden moment for India. And please clap once again, please.
Oh yes, please go ahead. Will we be cutting to Chandrayaan? Okay. Sorry, the technology here in this room is not yet that advanced as Chandrayaan would like us to be. But yes, it's going live on CNBC. We are trying to cut to it. But yes, a round of applause for both the big scientific achievement that India's been able to achieve, as well as to a panel which has been extremely enlightening and educating. Thank you very much, gentlemen.
Thank you so much. We are trying very hard to get you the Chandrayaan visuals. And if that happens, yes? All right. The celebrations are on. All right, I think we can proceed. The big moment has happened. Shireen, may I have you back on the stage? And now we are commencing our fireside chat on banking on Indian economy. And ladies and gentlemen, put your hands together for Shireen Ban and Mr. KV Kamath. With a career spanning several decades, Mr. Kamath has earned a well-deserved reputation as a visionary leader, a master strategist, and a true titan of industry. His unparalleled expertise in banking, investment, and corporate governance has not only transformed the financial landscape of India, but has also had a significant impact on the global economy. And we are very grateful for you to be here. Over to you, Shireen.
Thank you very much, Mugdha. And ladies and gentlemen, it has happened. Mr. Kamath's arrival has coincided with the Vikram lander landing on the surface of the moon. It is history that has been created. For the very first time, a country has achieved what the team at ISRO has achieved. Yes, we can do better. We can give the team at ISRO a standing ovation, a round of applause. The Prime Minister is speaking at this point in time, is what I can inform you. But what a moment for the team at ISRO. Specifically after what had happened the last time around, I would imagine that there is collective sense of relief and, of course, extraordinary happiness in the minds and hearts of every single Indian. And I'm sure across the world as well, people cheering on the achievement. And, of course, what a moment it is. Mr. Kamath, what a perfect start to this conversation, sir. Truly a moonshot moment for India.
Indeed.
Your first reaction to what you're experiencing as we see these images?
I first looked at the number, $75 million. This is an impossible number. So it's almost like free mein kya milta hai. Chand mil gaya. I think it is not easy. Not easy at all, and congratulations to
It is a testament to the frugal engineering that ISRO has come to be known for, and you're absolutely right, $75 million, and actually taking the lander to the surface of the moon, a feat never achieved before.
Indeed.
So, Mr. Kamath, if we were to then talk about what this means as a moment for India, and at this point in time, I know that you continue to be extremely bullish about the strength of the Indian economy, the role and relevance of the Indian economy in the global order, and those images now playing out on our screens right behind us as well, so we can enjoy both moments at the same time. You know, you've often spoken about the fact that you're confident that India will be able to double its GDP over the next 9 to 10 years. Just in light of what we've seen happen in the past year itself, what are you most bullish on?
Yeah, I think several factors which makes one bullish. I look at two data points which are really beyond my conceptualization, I would say. One was the consumption of data. What has happened in the last 5 years. 5 years back, I could not have looked at the Indian data scenario and said that we would be the largest consumers of data in the world and be at the lowest price point. That's one. Second, even 4 years back, I would not have dared to say that we will have the largest number of daily digital transactions in our country, of any country. And you know, there are large countries our size there, who were ahead of us on both metrics, and we could actually take a step beyond, as it were. I think that, to me, adds to several other things that are building up. That is, start at the basics, the balance sheets. Yeah. The balance sheets of corporate India, balance sheets of the bank, financial sector India. Last 3-4 years, the sort of cleanup that has happened. And the ability of corporate India to fund itself. Not necessarily come to the banks. And when I started my career, 4.5:1 was the total leverage. Long-term debt, working capital debt to equity or net worth was 4.5:1. And that then corrected, particularly in the 2000s. Post-Lehman, it came to maybe 2.5, 2.6:1. And now virtually no debt. So you have a situation which is in a way appropriate, or has created a foundation for the leapfrogging. So movement in technology, clean balance sheets, ability to invest, ability to grow. And then you look at the other side, who will consume? The consumer, if my belief is, if you are growing at the numbers that are required to double in the 9 years that you mentioned, then the consumer becomes aspirational, and the consumer is ready. Again, if you want to look at, as this happened earlier, the period 2000 to 2005, 2008 was a similar period. The consequence of the opening up and steps taken in the late 90s. And let's put it this way, the white-collar revolution that happened, led by the technology companies, created a demand pull, as it were. And corporate India, which was then restructured, was able to meet the demand. Again, corporate India, as I said, clean. And today, the aspirational rush is created by all sectors. It is not just one sector. And I think even as we speak, there are more sectors being added day by day. Who would have believed that just in the last 6 months on the services export front, we have a positive. And that number, as I believe, is set to increase. And again, creates opportunities, creates aspirations, and so on. So there's a virtuous cycle that is in motion.
You know, speaking of this virtuous cycle, let me address the first point that you spoke of, and that is what we've seen as far as data consumption is concerned. You're absolutely right. We've seen data consumption go through the roof on the back of the fact that we've got the lowest prices for data anywhere in the world. But specifically from a financial sector perspective, while it opens up opportunities, it also means significant challenges, especially for the incumbents. We just had Mr. Kotak here, and he said that is the one thing that he's most paranoid about, and he believes that that is the one thing that the sector needs to be most paranoid about as well. You cannot continue to believe that you enjoy the regulatory moat because technology is going to be the big disruptor. How do you see that playing out? How worried would you be for incumbents at this point in time?
I would be terribly worried. See, if you look back again 20 years, there have been maybe 3 inflection points in technology as far as everyone, but particularly banks are concerned. In India, it was the late 90s when we could not afford a mainframe, so we migrated to smaller boxes, maybe a Sun box and an IBM box. And then we brought in technology into everything that we did. Thereafter came the cloud. And thereafter, you had what I would call cloud native applications rather than something that was retrofitted to the cloud. Today, with the open source, whole new equation has been opened up. And to verify this or to validate this, all you need to look at is the 1,000 or so fintech startups that are out there and the work that they have done with open source. It is tremendous. And if any bank really understands what work these kids have done out there, they will not go to sleep, I can tell you this. Because I have tried to understand, sit with them and see what they have done. No banker should be able to sleep. So it is the sort of work they have done at the sort of cost point that are there. So I jokingly tell people today, a banker should ask 2 questions. Or somebody else will resolve these questions and proceed. Fit hai kya? Is it fit for purpose? Fit for purpose. And most of these things that have been done, yes, it is. Then free mein hai kya? So if it is fit and if it is free, then you are not able to compete unless you adopt the same mindset. So that's why I say that banks will have to relive what they are doing and relook at what they are doing. The good news is that there are several solution providers who are now almost ready with solutions for banks, which more or less meet this criteria. So and retrofitting is not as difficult as was thought. So somebody would have the courage to take the first step. So we'll see who will take that first step.
Speaking of the courage to take the next step, and you said fit hai and free hai. Perhaps on the fit, banks will be able to find the solutions, whether in-house or inorganically, by co-opting some of the fintechs onto their own platforms. But can banks really be able to do it for free, as we've seen in the case of VC-funded fintechs? And what will that then mean as far as the margins for banks are concerned? Many CEOs in this room would want to know your point of view.
I'm sure there are fintechs out here. They will say that actually, if you look at their costs, they're not that high. The technology cost is not very high, particularly with open source. And even from the time that fintech started disrupting the last 3-4 years, things have evolved now. There are vendors who are able to provide you a complete banking platform as a SAS model. So pay per customer at the end of the year sort of model, where you don't have anything else that you had all this time. And I won't say what all that is. The hardware, the people, the software, all those things basically can be swept aside, as it were, and you could put something new. So it's a dramatic tomorrow. And all I'll say is that no bank, no financial sector player, why only a bank, can afford to not be in this space today. That is, embrace the new. The digital startups, the fintechs have already done this. Their problem is a slightly different problem. So when you talk of technology, I don't think I would like to talk about it, because they have excelled in technology. And that is what I think the incumbent players ought to look at. That is the sort of disruption that has been wrought, and try to see how could I do that as long as the technology is fit and it is free. Free meaning virtually free, not really you don't pay anything. You will have to pay appropriate charge for this.
Okay. That's as far as technology is concerned. But since you talked about the aspirational India, and you talked about meeting the needs of this aspirational India with the hope of being able to double the economy, what about the appetite of the banking sector? What would you like to see change there? What kind of evolution will we now have to see? Where are we in that next leg of evolution to be able to meet the financing needs of the kind that we're speaking of?
There are 2 or 3 opportunities here and 2 or 3 challenges, Shireen. The first is, we need long-term funding, particularly for infrastructure. The banks will have to think deep on this, because you cannot really assume that term transformation will always work. And the banks typically are with the, 1-year tenor, 1.5-year tenor, depending on the bank, is their maturity profile of deposits. So you can't lend, say, 5, 7.5, 10-year money, even though you reset the interest rate. Somewhere you will end up running an interest rate risk. So banks will moderate their lending to long infrastructure projects. The good news is you have got other savings modes that are coming up. So whether it's through pension, insurance, et al., which are, their needs are for longer term assets. So an infrastructure company could actually issue longer dated products, and that would be something that would be picked up by insurance and pension funds. So I think a virtuous cycle can be built as we go along. Then when you look at the banks have an important role. Banks would clearly fund what we call, in our project financing days, the shorter term needs of not the short term working capital needs, but the initial 2-3 year need. Yes, you need to have skills in terms of analyzing and assessing implementation risk, but this is something which matches the tenor of funds they have, probably could be a higher priced instrument, so they make money allowing for risk that could be there. And later on, sell down could happen, and this could go to people who have longer appetites. A few years back, we used to talk of this, that is originate and sell down. Could not happen because there was no counterparty on the longer end. Now there is a counterparty, a bunch of insurance and other players who need longer assets. So I think it's a right time to get this big push on infrastructure. Government has been spending for well-known reasons.
Yeah.
But I would think that everything is coming together again. This is where, again, my optimism builds up. What is it? Power projects, again, most of their issues have been resolved. I think on your channel today saying that DISCOM dues have dropped.
Yeah.
And as such, power companies are doing well, and they should do well, because I think the lesson is learned. On green energy, I think there have been hardly any defaults. So the DISCOMs have been paying and picking it up. The exchange that has been set up is working well. In terms of other basic infrastructure projects, we did not have any stuck projects except in roads. Roads also, NHI stepped in very well and provided the momentum which otherwise could have curtailed growth and economic progress. So both happened to I think the firm steps taken by NHI in terms of this vast rollout of highway capacity. And now these, there is again understanding that you have to pay for the road. So the FASTag is working very well. And so and the private sector is coming back into this. Again, a lot of new ways of financing this entire sector once you're done. InvITs are clearly one sector. And our regulator is clearly taking steps to make sure that that becomes something that is well governed, well regulated, well governed. And so on the infrastructure side, where there used to be a question, how will this work? Because projects are not viable, projects fail, and where is the funding? I think the answer is clear. Now, banks, as you said, are going to be rich with money. They have clean balance sheets. They have to lend. And to me, lending at the shorter arm certainly is a viable way for project financing. But a large part of funding, like of their offtake, like anywhere else in the world, is going to be retail. And over the last, almost 20 years, banks have become, I would say, now experts at lending to the retail customer. And the support mechanism starts with the scoring agencies. And now, not only the basic score that you had, but multiple, I would say, sources of information, which can go into your credit underwriting model. And of course, we can always say that that model can be overlaid with AI and machine learning and other things. Indeed so. I think makes your retail borrower a much more firmer proposition than what he or she was, leave aside 20 years back, even 3 to 5 years back. Because the data pool has increased, and your ability to crunch it has increased with AI and other secondary, tertiary, and other sources of information going into that pool. So I would think credit costs will come under, very much under what it was in the past, both for corporate India and retail India. And that's what banks will lend and banks will thrive. And infrastructure, the longer end will be met through the capital market process.
Given the opportunity that you speak of, as well as in your words, this next wave that we are in the midst of, which has really been driven by the advent and the adoption of technology, what kind of regulatory challenges does that throw up? And what kind of regulatory roadmap do you believe India should prioritize, India deserves at this point in time to cater to the innovation that we're seeing happening, as well as ensure that the guardrails continue to remain in place?
Yeah, I think excellent thought, because this is something that we need to now consider. But let us start with what data is up in front of us. I think the regulators have navigated the last 3 years. I'm talking now on the financial sector side extremely well. The the COVID challenge, the post-COVID handling of the economy, keeping interest rates low despite a lot of push to hike interest rates, which has allowed the economy to come back at the speed that it has, and at the same time nurturing technology and allowing it. And I would think that the regulatory approach of a sandbox is clearly working, and whichever regulator you look at today is working within a sandbox. And within that sandbox, if you look at the entire advent of fintechs and what they have achieved, I think is remarkable. Yeah, I have gone on record to say that what I see the fintechs having built is extraordinary platforms. They're extraordinary platforms. But unfortunately, their aspiration to valuations could have put them on a wrong track. So I'm sure they will correct themselves, and there will be a path for them. And I think at this point of time, they'll be carefully watched by the regulator. And the equation to me is very simple. If you do not make a profit, I can't see the regulator allowing you greater degrees of freedom to do various things. So it is basically, you regulate yourself first. And in that, I think the simple metric is you regulate yourself, govern yourself well, and make money, reasonable profit. And then I think the regulator will be open to looking at how you could expand your sphere of activity. So I think in another couple of years that will happen, because these players are very important from what I would say triggering systemic change. Because only by them being around will incumbents be able to change, because they would have had no option but to change.
So they've been able to trigger systemic change. The question is, how quickly will the incumbents then adapt? And you feel confident of the adaptability, or you feel less so?
See, again, the two metrics that I pointed out, the data consumption in 5 years, where it reached and at what cost, and our country being the largest, having the largest number of daily digital transactions, clearly indicate that you don't have too much time. If all that could be done in less than 5 years, well, UPI adoption virtually less than 3 years, 3.5 years. I would think that that's about the time that you would have to change.
So 3 to 5 year window is what you believe the banking sector has?
There is going to be a big rush of players doing various things. Now, let's step back and let's look at what all has already been disrupted, so that I should not appear to be just speaking my mind off, looking at a few data points. Question, what has happened in the broking industry? You had incumbents embedded there for 15, 20 years. Virtually in the span of the first 6 months of the COVID era, they were knocked off. And who were the winners? Basically straight through processors. At virtually, I would think, met that test, fit hai kya, free hai kya test. And they actually provided the product free. They may have made money in other ways, through a demat account and so on, but they disrupted. Who could be the next disruptors? I think the AMCs are going to be the next disruptors. Then would be general insurers. Life insurance is a little tougher. And the banks and NBFCs are, I think, clearly in line of sight of anybody who can put into play technology in an appropriate manner.
In the line of sight with the 3 to 5 year window, those are cautionary comments coming in there from KV Kamath that I think industry does need to take note of. Speaking of disruption, Mr. Kamath, at the listing of Jio Financial Services, you said that it's going to provide growth momentum like never seen before. Lay out for us the vision that you have. I know you won't talk specifics, but lay out for us the vision that you have, sir.
I think anything that I say will be a forward-looking statement, and I don't want to do that. And this
5 years is too forward, sir. We're not asking you about the next quarter.
This is for the CEO to talk about, not for me.
No, what role and relevance do you believe an entity like this can play?
No, I sketched a larger picture for all players as to what's the disruption like. And I would think anybody entering the market today will need to wear that hat. And otherwise, I think success is going to be constrained.
What keeps you going? You're still at it. You continue to find new ways of staying relevant, of new ways of keeping yourself alive and learning, and opening yourself up to the opportunities that the environment presents. What keeps you going, Mr. Kamath?
I'll tell you, simply put, I keep going because I learn. Very simply put, that is all. BRICS Bank was a learning experience, NAPFID was a learning experience, and in this also is a learning experience. So you don't stop learning, and you find purpose in learning. That's a simple and true, something I've said from my heart. That's all that keeps me going. Otherwise, I would not have. Actually, I said that I've had 3 times in my career I've said I'm going to retire. First was in 95, just before I got back to India. I had said, I went out to Asian Development Bank for a purpose. I'm now actually putting in my papers and going back to India. Then Mr. Wagul happened. He came and said, lead. So I came back. And my wife asked me, what do you want to do now? I said, I want to go and learn. I may go to college again. I was then 46 or so. And I want to learn. This was 95 or so. Then it happened again when I stepped down from ICICI. I said, I want to learn. And some of my colleagues actually gifted me books. So those books remained largely unread because I went on to something else. So it's this quest for learning, I think, keeps me going.
It's the unending quest for learning. What is the biggest lesson that you've learned in the last few years? Or the biggest sort of takeaway, the biggest realization for you in the last few years?
Again, we are not factoring this in. That is the way the youth of, at least in our country, I don't necessarily track abroad, are driving directional change and their aspirations. All you have to do is, sometimes what I do is, before going to sleep, 10-15 minutes, I look at what are the blogs or vlogs on YouTube that are trending. This could be a 20-year-old kid who suddenly you find has got 22 million subscribers. He had less than 1 lakh subscribers just 2 years or 3 years back. You've got daily views of 7 and 8 million. Now you then try to see what is driving these guys. What is then driving aspiration of others? What are the comments that come in? And it's a huge learning as to the sort of aspirational drive that is there in maybe the 10,000-15,000 comments this chap gets on a daily basis. I think makes your day in the sense that things are happening. The youth is driving forward. And indeed, he is earning very well. I salute, and I salute every such person who's doing something interesting, where people are finding that this is inspirational and are trying to follow. I'm not talking of other things. Other things, of course, are there which educate you. But these are the sort of things, the youth, the way they are transforming is what is youthful. And today, again, for a fintech, I'll say this. If your, what I would call initial focus group, we used to call it focus group, is not between the age of 15 and 18, you're not going to succeed. So if you've got a product, try it out with a 15 to 18-year cohort, and of course, pay them for their advice. And then you see what will happen. Go to a school, run a session there, and you will get more inputs than all your senior team put together, mid-level team and junior team put together.
So is KV Kamath going to start a vlog anytime soon? No?
I'm content watching blogs.
Okay, content watching blogs. Yeah. I'm going to take 1 or 2 questions here from the audience. Yes, sir. Go ahead. We will get the microphone across to you. If you can just stand up, he'll find it easier to be able to place you.
Good evening, sir. My name is Sakar Yadav. I'm the founder of myitreturn.com. It's a tax filing website. We have also won the Atmanirbhar Award. My customers feel that we are fit for getting into the fintech space. Whether we can do it free or not, I think we will learn. My question is more basic. Is the debt to GDP ratio today, where do you see it going in the next 5 years? And what are the 2 or 3 things that India or anybody should be doing to see it reaching there, reaching wherever you feel it should be there?
Yeah, I think very good questions. But on your first, what you introduced, saying that the customer will have to pay, a reasonable thing. Now, you look at a scenario, this is true for everybody, where can you bring your operational cost to near zero? I think if you do straight through, you'll come to near zero. Can you bring your risk, its credit losses, to near zero? Again, using technology, all these techniques. Yes. Then what happens? You're providing a product to your customer, in this case, financial product, at a cost significantly cheaper than what it is today, because the margin would increase. That margin can be basically shared between the customer and yourself. So by doing this, you are not. So what you are leveraging is the open source out there. So I celebrate somebody like you. And I think somebody like you is going to be an important part of the wealth management product. So imagine a wealth management product where the the wealth management provider says, I will facilitate even your filing. Every single thing that is a data point today can be pulled from various plugs. Finally, it goes to your plug and is filed straight through. Is anybody doing it today? Not to my knowledge. So I think things can be done dramatically. Now, the second question was more, I think, down to earth. What about the debt to GDP ratio? So the way I look at it is, if you look at other countries, developing countries in particular, it is not that the debt to GDP ratio is significantly different. It is packaged differently. So you take China, for example. You said we used to believe that there was no government borrowing at all. Yes, there is no budgetary borrowing. And borrowing is not also through the budget of the provincial government. So where is it being borrowed? The provincial government has got an SPV or a company. That company is borrowing. Who's funding it? The banking system is funding it. What happens when it doesn't pay after 3 years? It gets rolled over. How many times it is rolled over? I have seen it rolled over 3 times at least. And then an ARC is created. And of course it was originally an ARC, 2000 used to be called ARC, but the last round in 27, 18, 19, they called it AMC. So an AMC is created and the cycle goes on. So now instead of 3-year rollover, the AMC issues long-term paper. And the same bank subscribe, old debt is cleaned up and you go on. So I think debt to GDP, there are very many ways to handle this. But what is I think not negotiable is you have to grow. This whole engine will come to a halt with even not overloaded debt to GDP, but even reasonable debt to GDP if you don't grow. So if you grow at 8 to 9%, your ability to service debt is of a different order as compared to what would happen if you were to grow at 3%. And at 3%, even if your debt to GDP ratio looked good, you may not be able to service it. So yes, it is a challenge, but the growth numbers we are thinking of, I think we will be able to manage it.
So I just want to get in a question here on China, since you brought that up as an example specifically. And I think many at this point in time believe that we are underestimating the slowdown in China and underestimating the scale of the problem in China. And this perhaps could be one of the biggest global risks and global threats that we will have to deal with, because a slowing China may not necessarily be the best as far as global growth is concerned. I wanted to get your perspective on how you look at China today.
Yeah, I think numbers are not very clear. General anecdotal evidence is it is slowing down. To what extent, we don't know, because the rating agencies are not lowering growth estimates, so we really don't know. I would look at the good coming out, for us in particular. We'll talk about the globe in a moment. For us, the good coming out is if there is a slowdown in China, commodity prices should immediately be comfortable, and we would have it right. As far as our country is concerned, we have the absorption capacity today. So we can absorb what we produce. So we can continue to produce for the home market and grow at a much lower price point than we otherwise would have done in a hot global market as it is. So I'm not too much worried about ourselves. The equation that we have to mention, we have to keep in mind is the interest rate equation. Because to me, all the good of the last 2 years could be upset if we allow interest rates to again go up. And of course, we'll have to figure appropriate measures to combat inflation.
But how concerned are you about that? Both that inflation that we're seeing may not necessarily be transient, is probably going to be longer, higher for longer, as well as the rate trajectory. The expectation was that we will start to see it ease, it may not.
I think I will look at the way I look at interest rates. This is, I have a lot of times said that I am not an economist, so you will
with that caveat aside,
pardon my ignorance. But let me honestly, I'm saying honestly, I think economic theory that was written in the last century is clearly outdated. That, to me, is very visible. And the West is ready to junk it. So did they respond in time to the sort of inflation that they had? No. They were lagging away, and Europe in particular. So they are learning to live with a new paradigm, as it were. I think in our case, I'm not for a moment saying that we forget inflation and do what we want on the interest rates. No. I think we need to calibrate. So, for example, now, if you have a problem with the price of certain vegetables or fruit or whatever, will an interest rate increase correct the situation? You need to have deep analysis on this, not desk chair analysis. And after that, somebody could say for A, B, C reasons, the interest rate has to go up. And when it goes up, this happens. I have not seen anybody put this out. But There could be other areas. Is the property market heating up? And what is the way I can control it? Yes, then you need a directed approach to settle the property market. Interest rate could be one of the tools. But are there other tools? So again, as I said, not being an economist, I have not delved too deep into this, but I'm sure people will now start looking at this issue deeper, because they have understood that living with the low interest rate has brought us tremendous rewards. For bankers, I'll put this across. China experience was interesting also on the fact that typical lending for corporate or retail purposes was around 5%. And our lending, let us say, is 10%. So now in our case, at 10% lending, we can figure out in how many years will your NPA double. Around 7 years, 7.2 years. If an asset becomes an NPA, it will double. At 5%, how many years will it take? Almost 15 years. So between 15 years, you will get 2 economic cycles, which will again bring the boat up. So we have not factored this into the whole equation, that once an asset becomes an NPA, within the next cycle, we cannot correct it, because a whole lot of processes.
Yeah.
And the interest rate is just cutting into the banks. So I think there is a lot of merit in looking at how this is managed, and is somewhere some new economic theory being written.
And perhaps more targeted intervention than
Is it worth us looking at it? No, I'm not saying we should look at it.
Something worth considering. I'm going to take the last question here. We're completely out of time. There was somebody. Yes, ma'am, go ahead.
Good evening, sir. My question is based on the discussion you had, where you told that to reach out to the age group, especially between 15 to 18 for advice. So something struck me, I just thought, imagine that in that age gap of 15 to 18. So what advice you will be giving for the fintech transformation?
Very simple. I meant it as one part of it, but I'll give you specifically something on that front. Basically, let us say you are developing a new app or a website. Website is passé now. It will be an app. If there's a new website new app being developed, who are the right people to give you feedback on that? Not somebody like me. Not somebody who is in the 60s, not somebody in the 50s, not in the 40s, not even 30s. It is that young cohort which can probably say what is it they want, because that's what's going to write. And not all the content, but the way the look, feel and the comfort with the website, the app, these are the people who will give you the most valuable advice. Then you can evaluate whether I want to. So entire set of advice or bit of advice they have given are only part of it. But that is where you look for.
So chase the early adopters is the message there from KV Kamath. Ladies and gentlemen, a big round of applause for the long-term India bull. And of course, it's been an absolute pleasure. Thank you so much, Mr. Kamath, for joining us here this evening on a historic moment as we saw the Vikram lander land on the surface of the moon, India creating history. And thank you so much for being here and sharing that moment with us. Ladies and gentlemen, a big round of applause.
Thank you, Shireen. Thank you, Mr. Kamath, for that engaging and informative discussion. All right, the stage is getting set for another panel discussion. All right, ladies and gentlemen, we are moving to our next discussion, which is titled FinTech and Banking, Collaboration and Lending for the New Economy. FinTech ecosystem is rapidly growing, altering the role of banks with the advancement of technology. FinTechs are leveraging technology to have lower costs, better product suite, agile operating model, whereas banks have the benefit of scale. It is imperative that collaboration between the two should accelerate so that they can benefit from each other's strengths to provide better and more customized service at the most optimal cost. And to discuss more on the collaboration between banks and fintechs, may I please invite Ritu Singh, Associate Editor, CNBC-TV18, to moderate this session. Ritu. May I also invite The panelists for this discussion, put your hands together for Chetna Sinha, founder chairperson, Mandeshi Bank. Sucharita Mukherjee, co-founder and CEO, Kaleidofin. Shinjini Kumar, founder and CEO, Saltap. And N.N. Srinivasu, co-founder, BillDesk. Along with Rishi Gupta, MD and CEO of Fino Payments Bank. Over to you, Rishi.
Thank you. Thank you, and thank you to all our wonderful panelists for being here. I think we can all agree that, fintechs have very much exploded onto the space in a very short span of time. I mean, India's home to what, 2,000, 3,000 plus fintechs. A bulk of them have just come about, by the way, in only the last 5 years. We have some 33 unicorns, we have 22 sunicorns and whatnot. What I want to ask, however, is what next? How has the role of fintechs evolved and how it will continue to evolve to be able to lend to the new economy? And since we have a panel of experts, as you can see, a lot of them specifically catering to a certain segment of society, we'll also cover how they're trying to bring about inclusion for the female borrowers as well. So on that note, thank you all very much for being here again. And Shinjini, I'll start with you about the role of fintechs itself. Traditionally you had the banking model, the gaps that they couldn't fill was filled by NBFCs. Further down the line you had MFIs, payment banks, and then technology encompasses everything. Are fintechs in the future going to remain these ancillaries, so to speak? Or do you think they can be the disruptors we thought they'd be when they emerged onto the space, but didn't really get that far?
So let me start out by saying that you contextualize this in the context of lending, because you took the example of largely NBFCs and banks. And of course, NBFCs are also non-lending NBFCs. But one of the advantages in the age of new technology, which is the platform economy or the digital or the mobile or whatever, where we are living now, is this ability to bring together a lot of the financial products, which has never been an ability that the financial system has had. So because traditionally financial system has been built, because distribution channels had to be built manually, so they were typically created vertical by vertical. I mean, I ran a consumer bank, and we would, even as late as now, we would have verticals that were wealth, credit cards, lending, secure lending, like that, right? But what this platform provides us, enables us to do is to bring all of this together. So a person is the user. So you as a user on Amazon are a holistic person who can be buying all different types of products, right? But it's you as a user and the platform as the platform. Unfortunately, in financial services, it's very divided. So insurance, wealth, lending are separate. So to my mind, what will really change the game is that we all talk about data, right? In the previous session we talked about data. Since the afternoon we've been talking about data. So today what's happening is the data is being created. But the ability to use that data to cater to a customer in a wholesome way is still very constrained for various reasons. I'm not going to get into that, and I'm sure there are everybody else on this panel who will have a view. But to my mind, the real game changer will be that ability to actually, then what Mr. Kamath said, na fit hai, free hai, to make it fit and to make it free, you actually need to be able to pull that power together. Today we are not there. So, yeah.
On that fit hai, free hai note, let me ask Srinivasu actually, because he's actually in the payment space, especially when we talk about UPI transactions, etc. Bahut fit hai and bilkul free hai. Is that the right business model for companies who are for profit? Especially companies like you that remain in the pure play payment space, haven't really ventured into the lending tech space, which many of your peers seem to be doing.
Before I answer that, I'll just address the earlier question Shinjini answered. Over the last 7-8 years that I've done many of these forums, the debate has gone from will fintech upstage banks to saying will they compete with banks to then saying will they collaborate with banks to your now question will they just become ancillaries. So that's an interesting way the space has moved. And in part that is addressed by your question to me, which is that, and what Mr. Kamath referred to earlier in his session, technology, innovation, capital availability all spurred the fintech space in a certain way. But it's at the end of the day a regulated space, and it's a space for serious players. The entry bar was historically low, which enabled innovation to happen rapidly, which is why you see a number of fintechs and number of business models. So there have been definite pluses from that environment. What has also spurred that growth is the host of things came together: COVID, UPI, people having to transact, regulatory framework, government policy which saw vision of saying that if you make the UPI as a free payment method, digital payments will advance very rapidly. So that's kind of come true. With that said, therefore, we're all at a very key point that payments are growing rapidly. A majority of them are mandated to be free. So where do you make money? That question still remains unanswered. I think from an industry perspective, there is hope that at some point, as markets or the product stabilizes, revenue or factor on that can come back. But in the short run, yes, fintechs are looking at other divergent ways to where they can make revenue and profits.
Well, I think the fintechs are quite hopeful. If you talk about hope, just look at the payment aggregator license applications. I think some 180, 200 companies have applied to be payment aggregators. Is there really space for a 201st player to now come into the ecosystem, in a way be able to grab a larger market share? Or do you think the space itself is too commoditized by now at this point of time?
My views on this topic are fairly well known. I think when we talk of technology-based companies, whether it's India or anywhere in the world, there's never space for more than 10. There is a process of evolution where hundreds compete to be in the 10. It's just a question of who survives to be in the top 10.
So who will survive? Who will be the top 10 in the current crop of players that we have?
Time will tell. If we all had that crystal ball, the remaining 190 would never participate, right?
Okay. Since you're not giving us that list, Sucharita, let me come to you. The point that Srinivasu also raised, first we started with fintechs, taking over some of the banking operations, and we said they'll collaborate, and now we're talking of them as ancillaries. Where do you stand on this particular matter, and do you think there are gaps that fintechs are able to fill, which even in the future, as banks become more and more tech first, they'll probably not be able to get into?
Yeah, so I just want to build on Shinjini's point around just the way our financial services system is built. It's built like product manufacturers. So in some sense, customers need solutions, holistic solutions. So for example, in India, 90% of India actually works in the informal sector, which has tremendous volatility of both income as well as expenses, as much as 45–50%. And therefore, by definition, you need to combine savings and credit, for example. And you probably need insurance for shocks as well. Now, for this customer who is extremely time poor, time is money, to say that, okay, now you will need to go to a bank for savings, to an NBFC for lending, and to XYZ insurance company for insurance, it's simply not going to happen, and the costs of distribution are going to multiply. Fintechs have a role in bringing all of this together into making this one coherent solution. Fintechs also have a role in inclusion.
Are you referring to fintechs becoming super apps, offering all sorts of BFSI services onto one platform?
It could be in the super app format, in a supermarket sense, but finance is very different from FMCG products, right? It's not like soaps that you just go and, look at 10 brands and I buy, I don't know, the pink one like Barbie. Just given the movie's popular. So it's not like that, right? So you need advice. There is inherent advice whenever you sell a financial service, because a financial service manufacturer is always making a call inherently in the sale that this product is good for you. Now, what fintechs can do is really understand the customer, what the customer needs, and bring the right set of products together. So yes, combine the products, but not like a supermarket, much more like a curator.
Okay, combine the products, but not like a supermarket. Chetna, let me ask you, fintechs don't have the legacy problems of traditional banks. They're empowered with a whole lot of data that they could use to make lending where perhaps traditional players cannot. Why is it that we still see, and as we were talking about before, fintechs even today solving for the problem of that 1 or that 10% of the population not really going down to the last mile, with a few exceptions, of course.
So let me say that, what fintechs are not doing it, or instead of saying that, I feel very strongly that on the supply side, where are we failing to listen to people? And for bringing that, I would just like to narrate that how actually the fintechs or the banks or the financial sector can learn from the people. And I would just like to narrate how Mandeshi Bank, or what were the learnings we had from the women. I mean, we keep on talking about the borrowings and lending to the people, and even when we talk about the financial inclusion, we talk about the lending. But sometimes you see that people, I mean, in our case, when nearly 2.5 decades back, everyone would think that, we need to lend poor women, right? But with me, it was like women came forward and they said, I don't. I mean, Kantabai, who was a street vendor, she said that I don't want loan, I want to do savings. And banks were not ready to provide that product which will allow her to save 3 rupees or 5 rupees a day. And she said, I went to different banks and banks denied opening the account because she's not an affordable client. And so then you said that, okay, if banks are not opening the account, why not start a bank for women like Kantabai who want to save 5 or 10 rupees a day? And that's how we applied for the banking license. Of course, the license was denied by Reserve Bank of India because these promoting members coming with a community capital, they couldn't read and write. So the bank, RBI said that we cannot issue the license. Now the whole thing is that community is coming with the capital, not with the investors' capital. We want to save. And so then women said that, okay, we will go to Reserve Bank of India. And you know what they said? They said we cannot read and write, but we can count. Ask us to calculate the interest of any principal amount. If we fail, don't issue the license. But tell your officers to do it without calculator and see who can calculate faster. Needless to say, we got the banking license, right? But you know what I would like to say is here the lessons are that even if we don't go to school, we can manage the fintech product, we can do the digital banking, and the challenge is on the supply side that how do you make the life easier for them? That is number one. Understand their cash flow, understand their ecosystem, and provide the solutions. So I would say, Ritu, that what I have learned from the last mile population, either it is for banking or it is for fintech, the one lesson I have learned is never give poor solutions to poor people. If you do that, you are successful.
Never give poor solutions to poor people. I think that is the line of the day. But Rishi, thank you for patiently waiting by. And I wanted to keep this for the last because, when payment bank licenses were given in 2015, there was so much jubilation about the kind of inclusion that they would bring about and what kind of transformational power they would have. Just 8 years down the line, we barely have 4 or 5 of those 11 players still in business. And I know you're constrained in the fact that you cannot give out loans, that a bulk of your deposits have to be invested in government securities. But, how do you see this business model evolving? Is it sustainable? Do you think in future we will not have more payment banks? Or do you think at some point you'll have to look at lending to live and to continue to survive?
Coming to this previous point, out of 200 payment aggregators, 10 will survive. In payments bank case, out of 10, only 5 have survived. So numbers actually don't really make any sense of it. But more importantly is how do you make the business model out of it? So as Kamath Saab also said that when you need to do business, you need to bring the cost down to a level that it becomes near zero. I think the opportunity in front of us, whether as a payments bank or any other bank, is how technology will enable us to bring the cost to near zero. And that is really the model in which we build up the payments bank. Rather than going in the conventional manner of setting up branches or ATMs
or a huge cost on the entire field force and everything else, we enable a lot of merchants. We now have 14 lakh plus merchants who enable banking at the doorstep of a customer. And I completely agree, poor people don't need poor solutions and don't need things for free. Now, I'll also give you an example is that if a person is ready to pay 30, 40 rupees for a transaction, mind you, if I ask anybody in the room, nobody will pay a penny for doing a transaction. But a poor person is ready to pay 30, 40 rupees because the alternate cost to him is far higher. If he has to go to a branch, he will have to sacrifice half day of his earnings, he will have to travel, means time, cost, which will enable. So the entire technology enablement through the payments bank ecosystem has actually achieved the financial inclusion mandate for which the payments bank were set. Obviously, the technology and digital has become quite big now. Fino started as a physical company. Now we are nearly 25% of our transactions are on UPI. It is moving into a physical to a phygital model now. What we also believe is getting the model right by building up a cost-light model but a scalable model, getting your DNA in place. If you want to really service the poor person or the people on the ground, the 900, 800 million people, you can't sell a Mercedes to a guy who wants a Maruti. So product has to be developed for the purpose of the person who you are trying to serve. So most of the banks and everybody has a DNA where they want to serve a different category of people. For servicing this kind of mass population, you need to have a common man of the country. You need to have an ability to scale your business, an ability to serve him the right product, the right cost. I think that is some of the factors which helped us grow our business.
Are you worried about scalability? Because while you're talking about this, I know you're also applying for a small finance bank license.
So when I look at the payments bank model, we have grown 6 times in the last 6 years, from 200 crores top line when we applied for the bank to 1200 crores last year. One of the very few payments bank who are profitable. We also went listed about a year and a half back. So we have done all the, I would say, all the right things which have to be done for any bank. And as Mr. Kamath also said, you need to be profitable. I think that is a big test for any payments company. And if you look around all the fintechs, you will find very few fintechs who are actually profitable. Maybe a couple of us are sitting here, but it's very difficult to find otherwise. But for us, the small finance bank license is a payments bank plus model. It enables us to do more on the liability side. It's also enabled us to offer a lending product to a customer which is already there. Right now, I have 80 lakh plus customers of our own bank. We do about, last year we did about 2.5 lakh crores of transactions. In the first quarter, we did 75,000 crores.
Sure, but you're not explaining why you want to move on from your payment bank model and become a small finance bank, because you yourself perhaps don't see that you could scale to the extent you can want.
No, see, the opportunity is big. So you have already created the railroads of the infrastructure, the people, the merchants ecosystem. Now the opportunity is to leverage that infrastructure better.
Since you brought up profitability and you pointed to your neighbor saying he's probably one of the handful of fintech players still profitable, let me ask you, Srinivasu, what are fintech players getting wrong? I mean, you became profitable within 6 years of operations, and I recall you saying that you had raised only $3.5 million. That's all. And this frenzy of funding that we've seen in the fintech companies, the high cash burn, and still, profitability is far away. What are they doing wrong? I know we're talking about a period that was a little while back and circumstances have changed, but what would be your lessons that you could share with them?
I think let's look at what the fintechs did right. They saw a market in which there was capital available to experiment and to build. So they figured how to leverage that, right? The market didn't put a premium or a priority to figuring out the right business model or profitability. So they did things right. They understood the market they were catering to, which at that point was the investor, and they did things right. Now, and basis that, they've looked at speed to market as being the key thing to work on. And so you build a cost model to achieve that objective. As the framework changes, I think what did they get wrong? I think what the market as a whole has gotten wrong is to believe that this would stay unregulated, right? The moment you put a regulatory framework or you anticipate a regulatory framework, there is a way you look at business and cost that's inevitable to come. So I think that's the transition phase. It's come at a point when people will kind of clean up their acts to figure out how to become profitable.
Okay, Sucharita, let me pick up from there on the regulatory aspect of it. You know, first they were unregulated. You know, it was often said that there was light touch regulation. Now with the digital lending guidelines and, you know, a series of circulars from RBI, whether it is almost killing the BNPL model and whatnot, how has life changed for you in the last couple of years? Do you think, you know, fintechs need to necessarily look at being regulated, getting an NBFC license to survive in this ecosystem?
I don't think so. I think that both models will coexist, and the digital lending guidelines with the first loss of 5% now becoming a reality, you know, actually now makes it possible, right, for digital players to exist. Now, the 5% has many implications. It means that you need to get your underwriting right, because you can't put unlimited first loss. You know, and you can't buy your way through a partnership, and therefore the underwriting model really needs to be correct. To go back to your previous point and to Srinivas's previous point, customer unit economics have to be positive. Right, that was sort of one of the golden rules, 101 rules of any business, whether it's a fintech business, whether it's an FMCG business, whether it's a bank. The customer at a unit level over a period of time must be profitable, right? And you can't be losing money when you do a transaction. As you build your book, you can't be losing more and more money. So I think the fintechs are evolving to recognize sensible rules of business, which I think is a really good thing. And the market is also now valuing that. Like Srinivas rightly pointed out, the market was not valuing that before, now it is. And in some sense that will also
legitimacy.
change.
Yes.
Correct.
But Shinjini, would you say Sucharita is one of the exceptions? Because, you know, a lot of these new rules that have come in have really disrupted the business model of certain players. Some of them even went out of business. Is the industry and the regulator not on the same page?
So I'll come to that later, because the thought that's been playing in my mind is this, I don't actually agree that when you, you know, the expectation that you will start to make money and only then you will be valuable is correct. Because if that's how the world was built, then the world would have never changed. The world has only ever changed when capital has moved to frontiers, whether it is the gold diggers of, you know, America, or whether it is the Silicon Valley people, or whether it is, you know, Indian fintech, which has been, so, you know, people's habits are hard to change. And ask me, because I'm trying to build a fintech for women, non-men, because, you know, men tend to be primary customers of financial services. I'm seeing this room and I'm thinking, oh yes, good. And so what happens is that you realize that and all of you know many women in your lives, right? Now think about how hard it is for this woman to, even if she understands that there are platforms available, to change from that habit of simply asking you on a Saturday morning to do something, because, you know, you'll not do the dishes, you'll not take the child for the thing. So you will probably be the person who will be happy to talk to the investment advisor. So that's what you will do while she'll be planning the party. She'll be as educated, she went to the same college and everything. But that's how the division of labor works. Now think about that person's habit changing from doing that to now doing this, which is, I will do this myself. That habit change will never happen on a unit economics logic. That will only happen on the logic of, you know, driving that change. Now, it's this, I don't know how many people here started to cook during COVID. A lot of men started to cook during COVID. I'm talking about, we cooked before COVID also. So a lot of men started cooking during COVID, and all of a sudden you had, you know, food ingredients being delivered in sexy packages to homes, and suddenly everybody was a chef, everybody was showing off nice food. Men started washing clothes, and some laundry company came up with a detergent ad for men. So you know what I'm saying? The equivalent of that, the equal and opposite of that to change behavior of a customer who's not used to doing things in a certain way, requires capital. Now, if you're a profit maker, if you're Hindustan Unilever, you will take that capital out of one pocket and you will say, I'm investing it into this new set of customer. Let men start buying detergent. They'll buy expensive detergent. It pleases their ego. Put some color on it and sell it to them. You can do it from your existing profit pools. But if you're a disruptor, if you don't have that capital that's coming out of your pockets, then you need that source of capital, because otherwise that person anybody who's vested in the ecosystem is not going to drive that change. So it's a very important thing that we miss out, because we go through these cycles of feeling very optimistic about the same guy. I'm sorry to put this on you, but you and your friends in the media were all celebrating unicorns and unicorns still a little while ago. Right?
We were reporting on how many of them were able to achieve the valuation as facts.
Right. And yeah, and so everybody was celebrating the valuation. Now everybody's brain has got wired to a different expectation. Yesterday I was reading this very interesting controversial article that came out about Tiger Global and whatever. And one of the sentences that really caught my attention was the fact that he writes about, when the next wave of AI-based bubble will come, then all of these boats will rise and the value will be extracted. That's the expectation on which financial services is built, and that is what bothers me as a, early life regulator or whatever.
I take your point, and on behalf of all my media friends again, we were just reporting on the facts.
Sorry, I just wanted to make this a little fun.
Skirted the question that I asked you, if the fintech industry and the regulator are on the same page, because, why these knee-jerk reactions? Why so much disruption?
I don't think regulators have reacted knee-jerk at all. So on this particular issue, I 100% believe that regulators have just reiterated what they were always saying. RBI from the beginning, by the way, I'm a bank supervisor of the 90s, okay? I'm sorry I'm that old, but it is, I remember my first inspection of Canara Bank in the 1990s. We were taught like children about credit quality. So the only thing RBI has ever bothered about and understood very well is credit quality, underwriting, and the obligation of the underwriter, okay? There has never been any sort of flexibility from RBI's side on that. Now, where did flexibility come from? Flexibility came because we had these happy-go-lucky, people funding experiments in making credit available to 16-year-olds or whatever. So we did have a lot of adventure, right? And none of that was actually supported by regulation as it existed. So all that RBI did, and in fact, before they came with the disruption, 1 year before that, they had actually come up with what was that thing called? There was a paper, right? They came up with some draft discussion paper or something, draft report. And nobody read it. Because that time there was so much fun doing what we were doing. Why would you read it? And then when RBI came and said, okay,
the fun has ended.
Then everybody woke up to it. I don't blame them actually. So the good thing about the fintech industry, as well as the VCs and the capital providers, has been that they very quickly realigned. That's the good part. Because at the end of the day, you want to be successful. Yeah. And to be successful, you also understand that all this...
Well, it's a tough position. I mean, with ever-changing technology, the regulator has to play catch-up. But Chetna, has the regulatory environment been supportive of, the kind of inclusion that you're trying to achieve with building for the women, reaching out to that last-mile customer? I just want to understand if technology is really proving to be the game changer. It was touted to be, and if the regulatory environment is conducive for that.
So when we talk about the regulator and the last mile population, the one thing comes is priority sector lending, right? And that also is a bit headache in the financial sector. And that actually, I was also saying that then what happens? So priority sector lending, you need to do for the financial inclusion. Forget the farmers. Chandrayaan pe pahunchna अच्छा है. किसानों को लोन देना उससे भी मुश्किल है. That is the situation, right? So वो तो सिर्फ तभी हो सकता है when you have a priority sector lending. This is not about the regulator. This is neither about the supply side only banking or fintech companies. It's about understanding the real ground reality. And how much are you ready? How much are you flexible? How much are you ready to take the risk? And while saying that, what I mean to say is, and I would here add, that, you know, experience with banking with farmer women, what I have seen, and I'll narrate one example, that actually when Mandeshi is lending to women, and not just joint liability group lending only, microcredit, so last loan is, you are repaying your last loan with your first loan. But when you are ready to take the risk and the cash flows are daily, what do? So you design a product, as Shinjini you mentioned, that you be flexible, you try something, you may fail, but then still because your mission is that, in that case I'll tell you that one of the lady, street vendor, Lakshmi, she was saving with Mandeshi. And I saw that she was not taking loan, fruit vendor, loan from money lender. Why? She knew that bank is, I mean, it's not that somebody needs to teach her. She knows that. But she was taking because the bank was providing the loan which was not matching with her cash flow. She wanted to take loan in morning and repay in evening. Now, even if I'm meeting my PSL lending, if I don't understand that, then how the real financial inclusion is going to happen, right? So in that we had to design, we did the digital diaries of moneylender. Understand how moneylender is operating. If you don't understand your reality, how are you going to design the product? And then we created the overdraft facility for the street vendors where they can take the loan in the morning and repay in the evening. Actually, the Jandan Neg Part 2 is that. How many? I mean, we have millions of Jandan accounts, right? But overdraft facility, not even was a few percentage of that have taken that. So I do think that you talk of regulation, you talk of financial inclusion, but the most important part is that you understand if our women do not have a smartphone, that's fine, that is fine, but she will be able to do. And I'm so proud to share with you that aspiration in India is that I'm not high school, I couldn't go to school, but I am doing digital transaction. That is the aspiration and success, and that is the real Bharat. And it is possible. Supply side just have to understand that.
I want to add to exactly, you know, Chetna and I became friends post demonetization because she does this annual event in January in Prabha Devi, and everybody should go there, where she brings these women farmers to you know, sell their produce. And she was worried about how will they do it because of the shock to the system and no cash being in the system. And obviously our product was a smartphone product, and it was all meant for, you know, at the time Uber users were our best users, unit economics and all of that. But the way she took that product and created the opportunity for all those women to use it, solving for everything. I went for that event, and it was like extraordinary how much solutioning had been done around a product. I don't think we do that.
Well, I hope we do it at scale to make a real impact. But, you know, we're running out of time. So, Charita, quickly a question. Also, the quality of these loans. We've talked a lot about inclusion, but you recently had the largest NBFC, Bajaj, in their last con call after their earnings, show some concern about the spurt of unsecured personal lending. And you know, some of these fintech players have not really gone through these cycles to really understand how it will play out in the longer term. It's a concern that the company had expressed. I just want to get your sense, while your repayment rates are high, there doesn't seem to be a concern on that front, but do you think we need to be cautious when we're growing this fast?
So I think underwriting quality is super important, and that, you know, like Mr. Kamath said, we need to get the cost of underwriting to be as near zero as possible, right? And in some sense, you know, underwriting scores, credit models can actually do that, because there is a wealth of both traditional and non-traditional data that's available. So for example, you know, about 12,000 crores of loans have been underwritten using Kaleidofin's proprietary underwriting model called Chi-Score, and with default rates of under 1.5%. And this has been through the pandemic period, including the pandemic period when losses were as high as 9 to 10%. So it's definitely possible, but the underwriting models that companies need to invest in need to be really solid, they need to be tested, they need to be refined because market situations change. And one of the other issues that's there in the personal lending market is that all of the lending is going to the same top
Over-leveraging.
100 million odd customers. We are a really large country, 1.4 billion customers, there are 900 million adults, and honestly there would be no problem of over-leveraging at all if we spread it out a little bit. And in some sense, you know, that's, and including women, which is an extremely excluded segment in all portions. So I think that there isn't an overall systemic issue, but I think there is an issue of concentration.
Okay. You know, we've very little time left, and I know this is going slightly away from the conversation we've been having. But Srinivasu, a quick word on CBDCs as well, because we can't talk about the future of payments and lending without touching upon that. Wholesale CBDC, yes, there's several, you know, use cases. What about retail CBDC with UPI in existence? You know, many say it's dead on arrival.
Honestly, I don't know the answer to that one, and it's very difficult to speculate on that. But at an intuitive level, yes, you could make a case for saying there are different kind of customer bases that would leverage UPI versus retail CBDC. Why is it a little difficult to guess is the framework around retail CBDC, what would the regulator push for, how would they, let's say, position it, all make a significant difference to how that can play out.
Okay, Rishi, would you like to add?
CBDC to me has a different purpose completely. This is one more tick from a digital currency point of view. And I believe it's very early days, though I've also downloaded, but I've still not used it. It will take some time for the market to accept it. But if I look at 5 years, 10 years hence, I'm sure this will definitely make a difference in the lives of people and how they transact. Who would have thought 10 years back that we'll become so digital and UPI will become everything for us? I think CBDC also can take that at some point of time. Right now it seems a little early in the day.
All right. You know, on that note, I'm going to quickly throw it open to the audience for their questions. Lata, yes. If we can have a mic here, please. Right here.
Well, just let me thank Chetna. It was such an eye-opener, the kind of work you do. I'm only going to repeat the question that Shireen asked, Ritu asked and Shinjini answered, but Srinivasa, I want your version on this regulator and fintech being on the same page. See, is there any instance of fintechs completely overthrowing banks in any country? Or is it everywhere the regulator is batting for the banks for maybe good reason? Because you want financial stability, protector of the depositor or whatever. What's the international example? Anywhere have fintechs won over banks?
No, nowhere. A short answer
Everywhere
is no.
because of the regulator.
No, but let me just add to that. Fintech in most of the markets is not regulated yet the way India is. Now, who's getting it right, who's getting it wrong, we will know 7 years later. That said, India was a market, given its history and the low bar for entry, right? Regulation at this early stage, to my mind, was important. In fact, to my mind, should have come in earlier in many sub-parts of it. On a different note, there's again construct of philosophy. As you've seen, whether it's in this panel discussion earlier, India has a mindset of winning on driving the cost lower. Most fintechs in other markets do not compete on that basis. When Apple launches a product, let's say in one street, it says, this is the existing cost structure, existing revenue pools. What is the innovation I am getting that increases the pie, increases GDP if you want? India works the other way. What do I do to compete, bring down the cost, first shift existing business from an incumbent to me and do it? So in that process, there's a whole lot of debate how one does this, but that's one reason why in other markets, leaving aside, let's say, the segment of cryptocurrency, if you see that as part of fintech, there's been light touch regulation because all innovations work to, let's say, expand pools even for incumbents. In India, the way markets compete, it forces incumbents who are regulated to kind of make the point saying, look, lack of regulation, regulatory arbitrage is hurting me, right? I'm both regulated and possibly listed. So how do you address this concern? That drives India.
Probably add to what Vasu is saying. If you look at China, which is the closest example, we know a case where it was completely unregulated and the way it became such a big elephant. Now the regulation came on it and the way it has curtailed the beast. I visited China some 10 years back and met the regulator there as part of delegation. So I met the regulator. The regulator mindset at that point of time also was let it flourish and then we will see what to do and then we'll bring in regulation. Our Indian regulator mindset is let me put the regulation, let there be boundary conditions around which you make your business model according to the regulation and the boundary conditions and then you grow on that. I think the Indian approach is far better. We know where we want to do. A payments bank is a perfect example of the boundary conditions which we can operate on and we make a business model out of it. I think the way the fintechs, I will not say all, but some of them, the way they were playing the market, I think it was bound to happen. It is also very important for the industry to have such benchmarks that they don't cross the line for the regulation to come and curtail it. SRO is a model in which many fintechs are now getting into being self-regulated rather than being regulated by a regulator. I think that's the direction. It's very clear in India's case it's going to happen.
Sure, we've run out of time, so I can take one last question. There's a table full of the top NBFCs in the country. If you had anything to ask your competitors, now is the time. Okay, not a question.
I actually
You
wanted to
silenced
add
them.
that what we underestimate is that when a disruptor comes, they change the nature of the industry. So the question, Lata, is that not that who replaced whom, but how the nature of that industry changed. So how did gold loan companies change the business of lending in India, or how did Zerodha change the way, So I think we need to kind of focus on that as well.
Sure, okay. Jairam, please go ahead.
Thanks, Ritu. My question is kind of very, very related to what you were just saying. Clearly, there is a lot for traditional lending companies to learn from the fintech ecosystem, and hopefully a little bit on the other way, in the other direction as well. I'd love to hear your perspective on what are things that that you think traditional lending institutions or how do you think traditional lending institutions will be different 5 years from now because of the existence of some of these companies?
Who would like to take that question? Or is that directed to someone in particular, then Jairam? No? Okay. Anyone? Srinivasu.
Since I'm not in lending, let me take a shot at it. See, I think all that is happening to my mind and is not different from what happened 20 years ago. I mean, we can put a label of fintech to it, but I think what is changing essentially is there are technology tools that are available for accelerated access to market or reaching customers. End of the day, what is fundamental to the lending business is still distribution beyond all the risk and other metrics, right? It's a question of whether you have a traditional business that was in lending, is figuring the right way to leverage a technology company by whichever manner, or a younger technology company manages to raise enough capital to figure out how to, let's say, buy out traditional NBFC and ride it. But I don't think what changes is the fundamental aspect of the one who's got the better distribution will win the game. Products will equalize at some point because what this fintech is doing is making available products easily to all traditional companies. So it's not that the traditional company needed to have its own tech platform. 5 seconds on it, it's exactly the way I think Infosys 15, 20 years ago, by offering a core banking platform equally to all banks, made sure that banks would quickly get there. It wasn't a function of how much bank A versus banks B own technology departments work. I think that's how it will perhaps play out for the lending.
Just to add to what Vasu is saying, I think the triple D strategy, which is distribution, data and digital, will make the difference in any business, not only about lending in particular. If you have a good distribution, which has a good data analytics and equally digital, I think that is the way you will be able to map the entire country, because what is going to happen is that the top end of the customers are already gone, the middle is already in the process of going. So what you need to fetch is the lower middle portion of the country. Okay. And for that, the common man, you need to have all the three pieces together.
All right.
For it to be successful.
So you're going to chase the bottom of the pyramid, but we have just 5 seconds each if you quickly want to add.
I think just fundamentally improved wallet share of, the Bharat customer is really what's going to happen, because the fact is that customers need these broader financial solutions and better customer engagement in their language.
Okay.
Yeah. On that point, pull versus push. Financial products have been pushed cashback le lo, saath mein ye le lo. And what Chetna said, na, that once your user understands and you understand the user, you make product available, customer can pull, customer can choose their payment schedule. You just need to execute that better. I think we will get there.
All right. Thank you very much for sharing those thoughts. Chetna, Sucharita, Shinjini, Srinivasu, Rishi, all of you, thank you very much for your time here. We're going to conclude it on that note. And thank you all for being a wonderful audience.
Thank you, ladies. Thank you, gentlemen. Thank you, Ritu. Thank you so much for moderating that panel. All right, ladies and gentlemen, we now move on to another fireside chat for the evening on the topic, Bridging the Gap, Transforming to New Age Digital Lending. And to moderate this session, may I please invite Rima Tendulkar, Editor, IT and Telecom, CNBC-TV18. Welcome. And may I also introduce you to our guest. With a career marked by innovation and deep commitment to advancing the financial sector, he stands as the driving force behind Nucleus Software. His relentless pursuit of excellence and his ability to anticipate market trends have not only propelled Nucleus Software to new heights, but have also influenced the evolution of digital lending practices across the industry. Please put your hands together for founder and MD, Nucleus Software, Vishnu R. Dusad.
A very good evening to all of you. Mr. Dusad, over the past few hours, we've all been brainstorming. How do we get India to achieve that $5 trillion economy? I think we're currently a $3.5 trillion economy. Banks, fintechs, all the financial institutions are going to be the fundamental pillars, and technology will be the enabler. So first, very quickly, can you tell us over the past 3 decades, how has Nucleus Software been driving the transformation of the financial sector in India?
Making financial services access easy and enriching has been our vision for decades now. As part of that vision, we've been trying to make sure that we create a solution which runs as an operating system for retail lending. And thanks to the solution that we have been working on for now 3 decades, I'm very proud to say that 40 lakh crores worth of retail assets, they are originated, serviced, and collected using our platform.
40 lakh crore of retail assets. Wow. And that would be a 50% plus market share in India?
Absolutely, absolutely. All the big names, literally, right from SBI through ICICI Bank, through HDFC Bank, through Bajaj Finserv, they all use our platform.
Absolutely incredible. That number is wow. 40 lakh crore of retail assets. So the question is, what is next? When my parents had to take a loan, the de facto bank was State Bank of India. And then the others came in HDFC, ICICI, Kotak Mahindra Bank. But as Mr. Kamath said, it's the youth which is driving the change today, and they have a lot of competition. They're spoiled for choice in terms of the lending solutions that are offered to them from various institutions. What can legacy banks do to transform? What is next? What are the solutions, the technology solutions that you're working on?
I think one of the core requirements for any legacy platform owner, legacy player in the lending industry is to make sure that the top management understands this part extremely well. The changes, the demands are changing at a very rapid pace, And unless the top management itself is convinced of this reality, their ability to respond to the changes would be very, very limited. And that is what has been happening. It's only when you have a very flexible platform, only when you are ready to do a meaningful change management, that you would be able to transform yourself to meet the challenges of this new reality. The youth, that 15 to 18 years old youth that we talked about, their expectations from your app are going to be of a different caliber.
What are they expecting now?
User experience, usability, instantaneous gratification. These are some of the basic expectations, and absolutely minimal involvement in terms of documentation and so on. So while some of the players have gone ahead and made loans in 10 seconds possible for existing customers, I think rest of the players, rest of the consumers are also expecting the same thing within seconds. So that is the level of expectation that we are talking about.
Okay, so customer satisfaction. But you know, Mr. Dussart, that's still perhaps covering the top of the economic pyramid, the middle of the economic pyramid. We still have a lot of Indians who are unbanked. And if India truly has to achieve this $5 trillion economy, we will need to bridge that digital divide. I think Ms. Chetna was telling us it's easier to land on moon, but then to give a loan to the absolutely bottom end of the pyramid. This is a problem that has plagued you for over a decade now. You've been working on technology solutions to make lending accessible and profitable. But up until now, we've not managed to achieve it. Can you tell us why technology has not been able to solve this problem? And what is next? What can we do to achieve that dream that even the farmer in the remotest part of the village, if he wants a 1,000 rupee loan, he will get it?
I think the challenge is huge. That challenge is ecosystem challenge rather than pure technology challenge. Along with the technology that now finally we have created in the form of UPI. The country is really proud of this fact that we are doing 10 billion transactions per month, and soon we will be moving to 30 billion transactions per month or 1 billion transactions per day. Along with this kind of ecosystem, we need to now leverage the transactions, the digital profile that we create using these transactions, and lend on the basis of that digital profile. Because when you are talking about the bottom of the pyramid, someone who is borrowing 1,000 rupees, she or he cannot create a profit and loss and a balance sheet. She borrows 1,000 rupees in the morning, buys some vegetables, and makes sure that right through the day those vegetables are sold.
And if he or she wants to borrow that 1,000 rupees on a daily basis, on an average, what's the interest rate which is charged to them?
Typically 1%.
Every single day?
1% per day, 365% per annum, and it can go to as high as 3650% per annum.
Did you guys know that people are charging interest rates of 1% per day, going up to even 10% per single day? How can we solve this problem?
Yeah, I think we have made reasonable progress in last 5 years in that direction. So with these these transactions, when they are captured digitally, the lender would be able to make out that while the purchases have been done for 1,000 rupees, by end of the day, thanks to the digital transactions, let's say the seller has been able to sell vegetables for 1,450 rupees. So 450 rupees is the profit that this vegetable vendor has made, or 250 rupees, whatever that amount may be. And when you observe this pattern for days together continuously, you would be in a position to say that, okay, as a financial institution, it will be safe for me to lend 1,000 rupees at, let's say, 50% rate of interest. And that would be a saving of at least 315% lending, interest rate, which would go directly into the borrower's earning, and those are the earnings which would add to making our economy move towards $5 trillion and $10 trillion and beyond. Because that's when we will be able to experience that the bottom of the pyramid is able to come out of the debt finally. I think we've had any number of movies for decades together which have talked about this challenge. And now we seem to be moving in that direction finally, where 365% rate of interest or 3,650% rate of interest would finally vanish over, let's say, next, 3 to 5 years or at the most 10 years.
Okay, so achieving this at a grassroots level and bringing down the interest rate, how expensive will technology be? You have to bring down the cost of technology to enable this.
Yeah, absolutely, very right. And thanks to the technology getting developed within the country, and we looking for solutions internally. The cost of technology is not that high. With open source and homegrown technologies, the cost is certainly coming down as compared to the cost at which we import the technologies that we have to continue importing. So yes, that is an important factor, and the domestic players are playing a very important role in bringing the cost down, just the way we are talking about Chandrayaan, reaching at the budget that it has reached, Chandrayaan 3.
I think $75 million.
Absolutely.
That's
absolutely.
The budget, and quite incredible. But are banks open to lending at 1,000 rupees, or do you think this is going to be a technology solution, perhaps for fintechs?
No, I think, as I mentioned, it is going to be ecosystem challenge, in the sense we will need banks, we will need the regulator, we will need the technology players, we would need government's involvement also. And that is when we will be able to expand this kind of lending. The priority sector lending that government has been wanting to make happen over the decades. Actually, it is this lending that needs to happen. And when we all the players get together and make it happen. The iron out the challenges that are there, that is the time we will be able to move in this direction.
So the big ask is bridging the digital divide. Just want to talk about the international expansion. Most of the companies, fintechs, when they try to expand internationally, they fail. How are you helping banks, financial institutions expand internationally beyond our geographical borders and its scale?
I'll first talk about our experience. We have implementations in 50-odd countries on all 7 continents. So we've been fortunate enough to get references from our existing customers in India when we were rolling out our products internationally. And it is those references which have helped the banks and the non-bank finance companies in all these 50 countries to leverage our technology. So that is one part of it. And coming to fintechs, I think when you are able to derive strong references locally, your ability to expand internationally goes up substantially. And that's what I would advise all the fintechs to do.
You use AI, ML all the time, right? Are there any ethical dilemmas?
Not if it is used, if AI and ML is used for the right purposes, but you never know how quickly those right purposes can become.
You're the custodian of a customer's trust, private, confidential information.
Absolutely, absolutely. And the models that you create, there can be biases and so on and so forth. So you need to make sure that you are keeping track of these aspects when you are using AI.
So the goal right now for you is to bring down the cost of technology to help bridge the digital divide, the economic divide, make lending possible at the grassroots level. It should be profitable, it should be accessible to everyone. Embedded finance is also helping in a very big way. We've got so many interesting solutions, right? Buy now, pay later has to become commonplace, but you have travel now, pay later. And you have been helping in that. I was reading somewhere that Bajaj Finance was the first company which actually helped dispersing loans when you go to a retail shop and make a consumer durable purchase, and you were the platform supporting Bajaj Finance in that. So what's next on the anvil in terms of innovative lending solutions?
While we have made our platform highly integratable, we have some 450 odd APIs which our customers can consume to do innovation at their end. What we continue to focus on the robustness of the platform. We have this responsibility of taking good care of the 40 lakh crores that we talked about. So robustness is a very, very important aspect for our functioning, and we continue to focus on that. At the same time, we are also focusing on how can we bring about changes that the marketplace requires at a faster pace. Till recently, or even now for that matter, our releases go out on a 6-monthly basis. We are seeing how we can accelerate those releases at a faster pace.
We've got very little time left, so if there are any questions for the man behind the technology solutions, please do raise your hand. Any questions for Mr. Dusad? Okay, on that note then, we are going to thank Mr. Dusad for joining in. It's been absolutely incredible to know how Nucleus Software has been pioneering the transformation of the banking sector and our financial sector for over 3 decades now, and we are most interested to know what comes next. Thank you very much, sir.
Thank you, Rima.
Thank you, Rima. Mr. Vishnu, what an enlightening chat, and what an insight into your work as well. And now, ladies and gentlemen, we have the final discussion for the day on the topic, the new regime for NBFCs building for the future. Well, the landscape for non-banking financial companies has undergone significant changes in recent times, largely driven by regulatory reforms, evolving market dynamics, and emerging risks. The new regulatory regime has placed increased emphasis on governance, risk management, and financial stability, aiming to build a resilient and sustainable future for the NBFC sector, bringing the larger ones at par with banking regulations, with the aim to explore the new regime for NBFCs and shed light on strategies and measures required to navigate this changing landscape successfully. May I please invite Prashant Nair, Deputy Executive Editor, CNBC-TV18, to please come up on stage to moderate this session. May I also invite the fellow panelists on stage. Put your hands together for Umesh Revankar, Executive Vice Chairman of Shriram Finance, Rajiv Sabrawal, MD and CEO, Tata Capital, Jairam Sridharan, MD, Piramal Capital and Housing Finance, Ramesh Iyer, Vice Chairman and MD, Mahindra Finance, and Mr. Alok Agrawal, CEO, Muthoot Home Finance. Over to you, gentlemen.
Check 1, 2, 3. Good evening, welcome again, and thanks very much for staying here, with us all through this event. I'm very keenly aware that and this panel is the last thing standing between you and drinks and dinner. So we will try and keep this chatty. We'll be It's a power-packed panel, and I dare say we kind of saved the best for the last. So it's absolutely, it's going to be an interesting chat. We've talked about banks, we've talked about sort of fintechs, but I think, the one engine for lending which we've not spoken about is NBFCs, and that's what we intend to do here over the next 45 minutes or so. The topic is called the new regime for NBFCs, building for the future. We all know NBFCs have been doing well. You just have to look at the last quarterly numbers. The pace of growth for NBFCs has been twice of that of banks. Customer bases have largely normalized across NBFCs. Asset quality seems to be under control, and there seems to be very, very few red flags. But what we intend to do is to kind of look beyond a little bit from the here and now and look at and try and gaze into the future, medium to long term. So I'll sort of look at just 3 or 4 topics here, and then we'll kind of go back and forth with the guests. We'll look at the regulatory landscape. Is regulation sort of supportive enough? Is it hurting? Is it helping for NBFCs? The business model of NBFCs. We'll look at the credit cycle, where they are, where we are there. We'll look at the liability side of the business, which is cost of funding. And then I'll sort of wrap it up with the digital push and how that is playing up across NBFCs. So without further ado, let me welcome in our panel. Mr. Umesh Revankar is head of Shriram Finance. Mr. Revankar, thank you very much for joining us. Mr. Ramesh Iyer is Vice Chairman and Managing Director at Mahindra Finance. Sir, thank you very much. Rajiv Sabarwal is head of Tata Capital. So thank you. Jairam Sridharan is Managing Director at Piramal Finance. Thank you very much. And Alok Agarwal is CEO, Muthoot Home Finance. Alok, thanks very much. The panel here, by the way, between them represents 5 lakh crores worth of assets under management, almost 5 lakh crores of assets under management. So, as I said, you'll get the entire sort of spectrum of NBFCs and business models. So let's, without sort of waiting any further, look at the first topic, which is the regulatory regime. One of the things which we used to talk about is the regulatory arbitrage between NBFCs and banks. Has that kind of gone away now for NBFCs? The Reserve Bank of India, the regulator, has tightened norms for NBFCs to be at par with banks, especially on NPA recognition, asset quality, etc. So I want to sort of take up that first. Mr. Iyer, I want to start by asking you, what is your view? Is that helping or is it starting to hurt a little bit?
So I think, all through the day you would have had panel where you would have heard what they cannot do. And NBFC exactly do what others say they cannot do. Right? And when we do that, obviously you will be regulated a little more than what was required. But I think it's always been a misnomer, I guess, that when people say, oh, the arbitrage is kind of shrunk and whatever else. And we've been here in this industry for too long. And I'm not too sure that there were too many areas of gap that we were benefited by. NBFC by practice were flexible model. And the flexibility was both in choosing a customer and taking a formal credit approach and lending, and then cover it up through a better recovery process. That was a simple model that it was. Right? And if there was any, if at all, could have been probably on the liability side. But the truth is that when regulator just come out with a new requirement, I think it's futile that we start debating, is this right, is this wrong? It's better to look at how do you put it in your business model and revisit your model, and then it becomes an acceptable practice.
You began by saying, Mr. Iyer, what NBFCs were created for, which is to be able to do what banks could not do or were not willing to do.
Yeah, I mean, there was one question asked in the previous panel, right? That there are people who want 1,000 rupee loan or a 2,000 rupee loan or whatever else, and they were not probably able to get, and the rate of interest was very high or whatever. I think one should never look at it from one line item perspective. One should look at it collectively. If somebody's got a dire need of a money and he's not getting it, you are meeting that requirement, then the cost of interest doesn't play a role there. The purpose plays the role, right? So I think that's the way the NBFC models have been built.
No,
so therefore, I feel that more regulation is always welcome. It only makes the business more stronger. I'll give you one very quick example. When we started the business, NPA was 365 days norm. Moved to 180-day norm, moved to 90-day norm. It's also moved now to daily collection, you have to date it. I think the businesses have survived and have become more stronger. So I don't think regulation hurts the business. it probably makes you ask more question about why and why now. So the timing of some regulations could probably be the discussion, but the need of the regulation probably is never the question.
Mr. Revankar, is this sort of bringing regulation at par with banks? Is it serving the need of what NBFCs sort of came into being in the first place, or is it a bit of a drag?
The way I look at it is, we became NBFC by choice. We did not look at arbitrage to become NBFC. So, if at all we wanted to be bank, probably would have applied for a bank in the first instance itself. We chose a segment, we chose a product, we chose a service, we chose customers, and then we became what we are. And over the period we have grown. And as Ramesh said, the regulation, the RBI, as the NBFC have grown large, RBI is trying to harmonize and try to increase the level of the what you call regulation to NBFC, because NBFC have become large. And also NBFCs have started reaching to the customer who otherwise may be serviced by a bank. That's also a possibility. But we continue to remain servicing to those customers which typically NBFC can service. So I think the RBI increasing or not increasing, bringing or trying to harmonizing the regulation along with the bank, and with pre-empting, in the sense RBI has been always informing it in advance, 1 or 2 or 3 years. So we are well prepared to move into that, and we are getting into it and managing it. So I don't think there is anything disadvantage to NBFC as of now. And all the NBFC have proved that they are able to manage the increased regulation quite well and perform well. So I don't really see disadvantage there.
Would I get the same answer if I spoke to smaller NBFCs? Because I mean, all of you are. So let me actually just bring Alok in. Alok, of course, heads Muthoot Home Finance. Would you concur, or you think?
Yes, see, overall, as my co-panelist said, the regulator always works for strengthening the sector. But then there is also a target customer, and what was the objective of the company when it was established to service whom. Now, as you rightly said, the very focus and existence of NBFC was brought about to cater to a customer who would normally not get a lending from a bank. Representing the affordable housing finance industry, we lend to a customer who's at the bottom of the pyramid, who would not be able to walk into an SBI of the world or an ICICI or an HDFC of the world, because he is almost, overboard with the bank infrastructure itself, leave alone the documentary requirements. So we lend to a customer who just set up a roadside shop. And yes, today we are measured at par with the bank customers who's probably, Cat A plus salaried employee getting a bank credit of ₹1,00,000, his ability to repay and the uncertainties which my self-employed, unorganized customer having the willingness to repay but may not have the financial discipline to repay faces are totally different. So to that extent, customer segment is different, realities at the bottom are different. But yes, NBFCs have managed to endure that. We had been given time when the regulation of 180 days became 90 days. We were given a three-year window to get this right. Now this 90-day window, the circular, we were given a 1 year, 1.5 year time. And now it is 0 day, it is daily stamping. And now we have to normalize the entire account before it is tagged off as non-NPA. Earlier there was an option of partial collection rollback. So that was working in favor of customers who couldn't maybe repay the entire thing but always had the intention to repay. Now even if they repay in part, they continue to be tagged as an NPA. And as and when they continue to be tagged as NPA, the mechanism to process the recoveries continue on them. So it causes a little bit hardship in the system, no doubt, for the end customer also. But that's the way it is moving towards financial discipline. So, and companies have come up the curve, but yes, there is a little, discomfort when you go to the prime bottom pyramid of the customer at the customer level. To that extent, I would agree.
Okay, so I did get a slightly different answer, right? I mean, when I put that
Prashant, if I may,
yeah, please.
I'll add one sort of analogy to this, which I think is somewhat relevant. So I have two kids, right? And growing up, I always thought I was being very lenient on the young one, right? And the younger one got away with stuff that the older one would never get away with. And so my older child was always resentful about this fact that, hey, this guy gets away with stuff, right? Now, my young one is a teen as well. And on his 13th birthday, we gave him a phone. And along with that phone came a whole bunch of restrictions about his life. Now that guy, the little guy, now believes that life is super unfair, that all these restrictions should never exist. It is natural that when you grow older, bigger, and become a bigger part of the system, that restrictions will come in, right? For individual players, that might feel a little bit painful, but it's a natural evolution of the system, and without that, it'll be kind of chaotic in the market. So while it is true that yes, particularly for the larger NBFCs, the regulatory ecosystem looks more and more like banks, it is what it is, and you got to deal with it. It's good for the ecosystem.
You know, you would all agree that we need more. I mean, I think an earlier panel was talking about how we need more banks. I mean, I think the SBI representative said that we need more financial institutions. So in that sense, and we need larger financial institutions if you are to be able to finance the needs of the economy, which will grow to 5 and then 10. It's a matter of time. So I mean, just come in there in terms of how the regulatory landscape is, and if it is all working towards that, and what needs to be changed, if anything at all.
Now, first of all, I think we are all blessed to have such a mature regulator. The fact that the financial services industry is growing at this pace, it'll be wrong to say that, we are more restrictive. I think we should give credit to the regulator that we are growing at this pace. Tell me, in which other economy is financial services industry, the top players are growing at 25-30%. There is no such industry. So I think credit should go to the regulator, and it's fair that they get this credit. Not only that, in the previous panel we were discussing about, whether it is restrictive for fintech players. If India is producing among the highest number of fintechs, if it's attracting the maximum amount of private capital, is it right to say that we are restrictive? I don't think so. It's fair to say that we are restrictive. I think it's fair to say that the regulator knows where innovation needs to be allowed, and when they sense that it is becoming large and we need to put controls, they are stepping in. I think that's the fair assessment, the way I would put it. See, we should all know that there are, spectrum of NBFCs and a spectrum of banks. If you look at the large NBFCs or HFCs, they are bigger than the top 5 banks, a lot of them. So, and you will find that probably the larger NBFCs are having much deeper penetration than a lot of other banks. So it's a spectrum which exists among NBFCs as well as among banks. So to say that banks are made for this segment and NBFCs for the other segment, I don't think so is right. You will find some of the larger NBFCs competing for more prime customers than some of the banks. So it really depends on what stage of evolution you are, and every entity has to, find its right place and behave in that manner. See, we are a very large economy. Our lending book is now close to 1,40,000 or 1,50,000. Yeah, 1,50,000 crore, around that figure. And this is, on top of that, we have the NBFC lending space, which is about 20% plus of the total financial services lending book. So if our lending book is maybe about 180, 190 lakh crores overall, and we are saying that for supporting India's employment or income generation, the economy has to grow at least by 7 to 8%, it means that the credit will need to grow at over 15%. and if credit has to grow at over 15%, we know that out of 190 lakh crores, about 1/3 or 1/4 will get repaid every year. So that also needs to be lent. So just imagine about 15% of 2 lakh crores, that's about 30,000 crores, no, 30 lakh crores, 30 lakh crores, plus the repayment which is happening. You will have to substitute that also, which is another maybe 50-60 lakh crores. So you will have to grow your book by close to 1 lakh crores. So do you have enough institutions which can support this growth? And that is why I think we need more institutions which can support this growth and allow for this credit to get delivered to the final leg. And I say this because, you know, today also we hear about entities who are lending at interest rates of 25%, 30%, 35% or so. Does an Indian customer really deserve to get credit at that rate? And if not, then how do we ensure credit at the right price reaches the final customer? And that can happen only with more larger institutions being present who can really spread out. And I'm not saying small, not smaller, even the smaller ones have to spread out and become large.
Right.
And that's how India's credit aspirations will get met. And I think the regulator knows about it and they are seized about this. And I'm sure, like they have always done, they've always stayed ahead of their times compared to other regulators. They will do the same in case of our economy too.
You know, just to move this, the regulatory aspect of the discussion along, banks versus NBFCs, or rather banks, NBFCs becoming banks. We've had instances of many MFIs becoming small finance banks, more than a few instances. And this is an old debate which comes up. I mean, what is the end game for NBFCs? Is it NBFCs or eventually, you know, what is the push? Is there a push, Mr. Iyer? What is the, you know, just your thoughts on that?
I think it's a choice we will make, right? I think Umesh said it right at the first answer, that if we wanted to be a bank, we would have applied for a bank then. But we chose to be an NBFC. And likewise, when a time comes and you think that bank is a better model compared to NBFC, one will make that choice. I think it's choice. Nobody will push you to do A, B, C or D. Because, you know, if you look at the upper layer NBFC, all the industry houses largely, we are all sitting out there. So there's also a regulatory change which is required if we have to become a bank or whatever else. But I think it will be by choice.
I've asked you this before, Mr. Revankar. Your thoughts on this?
No, I think Ramesh has answered it. So I don't think. See, why do you want to know end game? There is nothing like end game.
Not, I don't mean end game in that sense. I mean, what's the?
If at all, it has to be decided. It has to be decided by the regulator. So I don't think the NBFCs would be happy to be in the place where they are because they're servicing the customers. They have chosen to be in this space. So I don't think there is. You need to really look at what is the next. I don't think it is necessary to look at unless there is some serious thoughts on part of a regulator, government, and how to increase banking to the segment which we are servicing as a NBFC. If they at all they decide, then probably there will be some way out. Otherwise, I don't think it is necessary. Because if you remember in 1969, when they nationalized, government had a thought process that I want to make banking available to all common man. So that was the thought process. Unless that kind of a thought process comes, I don't think there is a necessity.
I think just want to add, every 10 years or 5 years, this question get asked to all of us. And then we are still continuing to be NBFC, so I think...
Jairam, your thoughts?
See, with the greatest regard and respect for both Ramesh and Umesh ji, I will say that I have a slightly different view. See, Ramesh and Umesh ji have the great advantage of having deposit-taking licenses, right? So they can actually get consumer deposits.
This
on
is
the
competition
side.
speak, okay? Don't worry.
So, you know, when you are a large NBFC who doesn't have a deposit-taking license, the thing you got to worry about is how large can you get with being your liabilities, with having your liability side completely dependent on the wholesale debt market. We've been talking about increasing depth in Indian debt markets. Lata has been doing shows on this for what, like 15 years now or something. The depth is what it was, like it has not gone up. So there is a point beyond which raising debt wholesale to manage very large NBFCs is hard. It's a little bit easier for you gentlemen. For people like us, it's a little bit harder. So I do think there is merit in coming up with some approach through which larger NBFCs can access public deposits or retail deposits, whether it's through a banking license or through some other means. But that granularity in liability side is super important.
I think you would agree with that, right, Mr. Sabharwal? You would agree with Jairam?
I think we all know that liabilities is one of the most important things for any lending institution. Not only the amount of liabilities, but the stickiness of those liabilities, the cost of those liabilities, all of them are extremely important. And the more broad-based they are, the more granular they are, the more stable will be the book. And I think I would agree with Jairam on that point. We need to find out, since we said that the credit needs of the economy are pretty large, and we want more institutions to become larger, there is a need to look at how liabilities can be made more granular and more diversified for a stable system to exist which can keep growing.
Well, different perspectives, right? That's what
Just to add to that,
yeah, please.
We should also commend the regulator here, because time and again they have given opportunities for the choices to be exercised. A concept of small finance bank came in the last decade. So wherein the companies who chose their journey in that way were able to access that license. Today we are speaking on-tap banking license. So the regulator is also aware of the fact that a person progressively who wants to take a leap of faith in that journey is allowed that access. So there are today choices available on both sides of the table. It's actually up to the individual entity to decide what is their path in the journey. So that way it's a fair play, I think.
Well, I know we can go on about this on this topic, but I want to move on to the next one, which is...
I only hope the sitting arrangement is not made on that basis.
Well, not at all. No. Well, credit quality, right? Let's talk about that, because it seems to be pristine. We talk to banks, you talk to NBFCs, and everyone seems to say that, well, no problem for the next few years. Customers are repaying on time, leverage is low, digital footprint is very large, so we know the customer like we did not know ever before. So somebody earlier said, I think it was Mr. Shyam Srinivasan, who said that unless the customer has an intent to default, it's very unlikely that NPA levels will go up substantially at all. So I just wondered your thoughts.
You'll probably see another split house on this one. But we have all been in this business long enough to know that such great news doesn't last, right? Of course, we are going through a peachy period right now, like nothing looks bad. But just because we can't see what's coming up, and just because everything in the immediate line of vision looks great, doesn't mean that that we can imagine that a year from now, 2 years from now, we'll still be in this period. It's impossible. Where we are today is an environment in retail lending in India where growth is high, margins are solid, capital adequacy is superb, risk is at kind of all-time lows. There is no way this persists. This is a freak particle of nature which is going to go away. So I think we've all got to imagine that. Right? And now, which part of the segment it might come from?
How many years out, you think? I mean, best guess.
You use the wrong word there. I would say months. So, see, my feeling is, you look at where, as I said, you will see a split house on this one, because very learned people are going to disagree with me. See, you look at the data. What do we see right now at the industry level? We see secured lending products, risk continuing to come down across the full industry level. You see personal loans products, risk was coming down for a long time and now it has stabilized. And you see credit cards, it was coming down, it stabilized, and now it has started going up. So credit cards has gone up. Within personal loans, which look stable, if you split it up into small ticket and large ticket personal loans risk has already gone up. compared to 6 months ago. So credit cards and small ticket personal loans risk is already up. MFI just went through a cycle 2 years ago, so they're not going to see any problems for a little while. But the semi-urban, urban markets, unsecured lending is risk going to be remain where it is today, 6 months from now? I would bet serious money against it.
So, your 55-60% is retail, right? I mean now,
yes.
Your book. And everyone wants to do retail, everybody is doing retail, but as you said, I mean, let's hear it from this side of the panel as well. Mr. Iyer, Mr. Revankar, would you disagree? I mean, rural is a big focus area for you. Yeah, go on, sir.
I think he forced me to disagree, so I will disagree. If I agree, he will doubt his statement. No, but I think, one has to look at it as what class of assets are we talking of. And I can kind of go on the credit cycles, how it hits, what hits. And we've always believed that in this cycle, you have to be very sure and clear about circumstantial and intentional defaulters, right? If you've chased, you've kind of chased growth and you've lent to people, and you believe that, their ability to repay itself is doubtful, of course, they will all have this problem whenever such cycles hit. And if you look at the book, most of the people book, what is NPA today are actually circumstantial NPA, because if it is an intentional default, we have already taken action against it. Either we have taken back the asset and settled it, or we have provided for it and be done with it. And also look at this cycles, how the whole mechanism works. 90% of the people in this country borrow and they are responsible to repay. You don't even need to follow. It's the 5% who require some nudging, some follow-up, some reminder they pay. The whole struggle is for the last 5%, right? Now, if you do a normal lending, if you've kind of chased growth and you've done some abnormal lending because you want to grow your book faster, right? And those will hit the cycles and you will see some problems. And I don't mind if I have to take our own example, our NPA sometimes shot up substantially when the rural markets don't behave well. But we don't write off all that money. In the next 2-3 quarters, we see all of that money coming back, right? So I think these are the nature of these businesses, and all the business models must be built around living through these cycles.
But do you believe...
If you generalize that, is the credit cycle hitting low end, etc., I'm not seeing that in rural, because for us, the typical cash flow is, if there is sufficient cash flow, people will buy vehicle only when there is a cash flow. And we are continuing to see the demand for vehicles or tractors or whatever else is so high that the footfall at the dealership continues to be high. And therefore, I'm not able to see it happen that way. And the 4 cash flows which normally drive rural is the infra, the farm, the tourism, the people movement. They're all doing pretty well. So I'm not able to subscribe to this view that the collection cycles are going to hit hard. And we have had our best first quarter kind of a thing, because historically the first quarter collections fall low and then the NPA shoots up. And in this round, we saw collections go up and NPA lower than even March. So I'm not able to honestly subscribe to that view.
Jairam, sorry, you want to put numbers to it, system-wide retail? I mean, what will, when you say is months away, to what is the degree of the problem? I mean,
look at the industry-wide numbers on kind of risks and delinquencies. You're looking at 90-day delinquencies in unsecured credit. And by the way, neither Ramesh nor Umeshji do a lot of that stuff. So they'll probably be unscathed in that type of situation. But you look at unsecured credit, and you got 90-day delinquencies at the industry level at like what, 1% or something, 1.25%, whatever it is, right? It's a really low number for a business. Like, let me take our example. We are doing unsecured lending at like 18%. Right now, you're making 18% returns for a business which is 1% credit, credit cost. We are making too much money in that if the risk is not going to go up, right? That's what I mean by saying that this is a freak particle of nature. Like high returns and low risk doesn't last. Either the returns go away or the risk comes up. Right, and in some pockets of unsecured lending, some pockets, not all, as I said, MFI is in a different state right now, but some pockets of unsecured lending have had too good a time over the last multiple years, and I think it's getting to a point where it seems unsustainably good.
Mr. Sabharwal?
No, I have a view somewhere in between. I believe that we have, in the last year, we saw probably our best year in banking or financial services industry, where growth was very high, margins were high, delinquencies were low. I think this year is already seeing moderation in margins. Already it is happening. And if it has not happened for some, it's going to happen. I believe the delinquencies this year will be higher than the previous year because previous year they were extremely low. I feel growth may continue, though we will need to watch out for growth. You know, if all goes well, we may still see reasonable growth. However, I don't believe that there is any cause for concern. Last year was abysmally low delinquencies. You know, in certain products we had negative delinquencies, which means we recovered more than what flew into NPA, which is, you don't see that normally. So, but the credit cost will be still much lower in this year compared to the pre-COVID times. But they will be slightly higher than last year. So I don't feel there is a concern on this point, and credit quality still will remain strong. But I agree with Jairam's point that any sector which sees high growth, we should be very careful about that. And if it is more of unsecured, we should be even more careful about that. There I believe that everybody will not face the same scenario. Companies who do believe in much stricter risk management, who use data more effectively, will perform better than the others. Even in the 2008 crisis, we saw certain players came out unscathed and certain players did suffer. So I don't think so we can paint the whole industry with the same brush. There will be set of players who will perform better than the others. I don't feel there is a concern for panic, but to say that this year will be as good as last year, I don't think so.
Let me add one quick thing. It's, you know, some of you might know, Rajiv used to be my boss many years ago. And in the years that I was working for him, I would always get excited about something. And he would always calm me down, saying, "Bachche, thanda rakh." So I see that all the years haven't changed anything.
That's well said. Mr. Revankar, in the commercial vehicle side, any issues at all, or steady?
No, right now I don't see any kind of increased risk, mainly because I don't see a competition among players to somehow increase LTV, lend somehow, increase the volume. That kind of a peer pressure I don't see. So that is a good sign. Everybody is disciplined enough to lend to their core customers, and therefore I feel there is nothing, advancement of risk I don't see. So I think this year I don't really see heightened higher NPAs or risk is my view. Maybe it will vary between the segments.
Maybe as Jairam clarified, I mean, it's on the unsecured side, right? I mean, possibly. It's possible. Bajaj Finance, for example, said rural unsecured, they're kind of putting the brakes and they're not going to grow very aggressively, Mr. Iyer. So maybe it's the unsecured part of the portfolio?
By not lending, you can avoid future risk, but what you have lent to, you have to handle it, right?
Yes.
Yeah. So, therefore, it's very difficult for anybody to make a judgment on, oh, is this coming? I think these are business models. You should partner the customer and live with the customer during this difficult time. I don't think there can be a judgment made. Okay. I mean, if you lend to someone for a 3 year, let's say next 6 months are going to be bad, what are we saying? They will repay after the 6 months. I think we should start analyzing what are we really calling as risk. Something which is going to get delayed and will come back, is that a risk? Or something that you think have taken and will not repay at all, is that the risk we are talking? And if we are talking of the second one, I don't think we see that happen at all. But if someone is not going to pay, let's say for some reason this year monsoon little more delayed and the crop prices don't get announced, it takes another 2 months for that to happen, there could be some delay in installments that could happen. And I don't think we want to categorize that as saying, oh, the market has fallen and there is a new risk that has emerged there. We would say, oh, this requires an approach for us to therefore partner and delay it for a little more. But if you find that you've lent to certain segments who took this with a purpose, that the purpose itself got defeated and the whole segment is suffering and they are not likely to get up again, which was the COVID discussion at some stage, which segments would vanish. If that kind of a fear is seen while you're lending, then we must talk about, oh, is there a new risk emerging because of the lending going up? I don't think we are seeing that.
Prashant, just to add one point, I think, again, credit to the regulator that all NBFCs and HFCs moved to NDS, in which we actually use the data for last 60 months to decide what provisioning we should take on our assets. Whether we don't have, the same provisioning for all assets which are less than 90 days. So actually with DPDs increasing, the provisioning is higher. So for the NBFC and HFC system, this has made the system more robust. I don't think so this can ever lead to shocks happening. If somebody's portfolio is going bad, it will gradually see an increase in provisioning happening. Nothing will happen, suddenly. So I think that has also made the whole system more risk-proof compared to, the banks.
Jairam, the digital push of NBFCs, digital adoption, is that making things easier? I mean, it's definitely making it easier to reach customers and lend faster, etc. But coming on that aspect, the digital push from the side of asset quality and managing that, I mean, is it a help? Is it a headache?
I think that it certainly helps, but we shouldn't get overexcited about many of these things. The fundamentals of lending haven't changed in the last few hundred years. Right? What has happened in the last 10 years by, suddenly, digital technology is becoming more easily accessible or the cloud becoming more prevalent hasn't changed the fundamentals of lending. As we saw during the pandemic, purely using digital means to try and collect from customers who had migrated out or whatever it is, didn't work out very well, did it? Yes, you have some new tools now. Before the panel, some of us were having a discussion offline, and one thing that we were discussing is that because a lot of customers are paying digitally now, there is a baseline level of payments that just comes without you doing a lot of collections effort, right? And even in tough times, you will see that level of collections is coming. So your baseline has improved for sure. Your ability to analytically model and in an automated way reach out to potentially kind of, bouncing customers has improved quite a bit, and all that has helped. But the core of collections, which is knowing your customer base, being able to segment them and figuring out which customer might be vulnerable, and changing your actions or the severity of your actions on collection based on that understanding, in that the thinking work, the strategy work, and the customer insight work still remains more important than the technology of how you reach out.
If I may just add to that, and Jairam put it very, very correctly, by becoming more digital, by having more UPI, my customers' income levels have not gone up. They still remain the same. The behavior has not changed. So digital is not helping for them to have more savings or more income. How digital is helping us is it's helping us in certain cases to reduce our intermediation costs, whether it is collection costs or in certain cases.
Mr. Sabharwal, does it help you make the right credit decision? I mean, because you have all these digital footprints and...
Yes, it does help because, again, I'll just come to that point. So one is the cost of collections or the cost of reaching out to customers. Those are the cost, your back office costs because of, a lot of bots being used. That cost is coming down. So one will have to look at whether the reduction in these costs compared to because of competition, you need to spend more to acquire a customer, where the equation is playing out. I feel today the equation is playing out in favor of lowering of the intermediation costs. So that is benefiting. I think the point which you are talking about is, is it helping us in making better credit decisions? No doubt about it. But that really is a function of how does each organization capture data, use that data, and more importantly, respect that data. Because I can tell you this, there is no organization in the country who will say that we don't use analytics. There is no organization who will say that they don't have their own data lake or data warehouse. I think the difference only lies in who really respects that data and follows that data compared to others who respect gut more than the data.
Just want to make two quick points on this. See, for long, until the data was available, etc., we were running business models through knowledge, right, and interaction. Now has come a time where sufficient data and quality of data has improved, and the way we store and analyze them is available. So I think the models are moved to using knowledge and data together. And that's where the enhancement of better underwriting, etc., comes. That will help underwriting better loans, and therefore, obviously, your delinquency levels, etc., will be better. But when it comes to digital, I think we shouldn't confuse between methods and means. Right? Digital is a method of repayment. I don't think my customers have ever told me, I don't know how to pay you, I got the money. Right?
No, my question
and therefore, we've done nothing to improve the means of a customer to repay.
Absolutely.
That's going to happen on the ground.
Which is what Mr. Tabarwal said.
Yeah, so we shouldn't mistake by saying, oh, if you invest in digital, your recovery is going to be substantially good. Bad cycles will come, recovery will suffer. And if you run a model only digitally, you don't even know where your customer is, your recovery will further suffer.
Correct.
So we shouldn't give up on interacting with the customer. If they are an earn and pay segment customer who has to make a decision when he has 10 rupee with him, he has to make a decision whether I discharge my liability or I use it for my next use.
My only question is, has all the use of digital, while you're making a loan, when you're making that credit decision, does it in some way, more structural way, because you didn't have all these data points earlier, over a period of time, lower the level of risk of, making bad credit decisions? Is that something we can say, or
I think
not really? We can't.
No. Definitely things are very different from what it was even just 2 years back.
Right.
So it's continuously transforming to the new level, undoubtedly.
Okay.
But I still go back to my first answer, which I said, you have to have sufficient knowledge of what business you are in, which market you are in, which segment you are working with, what's the end use of the asset for which you are lending, how is he going to earn to repay from this. Nowhere you got the data to support all of this.
Correct.
Right? And therefore, you have to use your knowledge of what
plus,
you know, plus all these new means, put them together and say you're doing a better credit and a better recovery.
Mr. Remakar, you want to come in?
See, you underwrite a loan. You don't distribute a loan. This is a fundamental.
Correct.
That means you need to understand the financial risk you are taking. Now, what data you are collecting, what information you are collecting, earlier you were collecting by orally talking or collecting by visiting. Today you are getting ready-made information which is already available in the system to help you to take a call. So it's an analytical which is helping you take a better decision. And the human error which was happening earlier is reduced. To that extent, it has become much better. Otherwise, I think the basic risk-taking has to be there in any lending. Otherwise, it is not lending at all. So I think that's one point. And as other thing which we need to understand, what you collect is over the period. Like in the olden days, or when the hire purchase agreement was done, you collect all the money, then agreement value, then give 1 rupee, then you give the asset. Till then, the asset was owned by the financier. That was the model. It got changed because there was a tax on the hire charges. It was split as principal and hire charges. On hire charges, there was a tax. So every NBFC changed the model into loan cum hypothecation. So everybody is now forgotten that last installment and change of ownership or closing of loan is important. So you can't have a word till the last money is paid. So this is a fundamental in financial services, whether it's a bank, NBFC or a loan. So I think the what you call data analytics or the digital, everything is only helping you, but not that it is changing or disrupting or the way we are doing business. That's my view.
Gautam, here,
This is the only business where what you sell, you every day pray has to come back. And that has not changed and it will not change.
Well put. Alok, yours is
from my industry point of view, digital.
It's the most predictable.
It's the most predictable, but I would certainly put my finger out and say yes, it has improved the way we underwrite a lot. We are today better informed. We continue to take calls, but they are more informed calls. the tools which we have to verify certain informations which were more on the field, human biased, have become more structured. I mean, right from verification of a digital KYC to many other things are more accessible and foolproof today because the system is digital. It saves us a lot of underwriting manpower, underwriting time. Our turnaround time to the customer is much better. We are able to see some, blinders which earlier we would not been able to see. So to that extent, yes, it has added a zing in the underwriting. It has made it more efficient, and to that extent, it has made the portfolio more secure, if I may value add. And on the collection piece, yes, the human element of the customer would always remain, but logistically, collection has become more efficient. You don't have to wait for the customer to walk into the branch to pay or send your guy to collect the payment. It has become very efficient logistically. To that extent, on both the pieces, efficiency has increased.
Got that. The screen here is telling me that our time's up, but I just want to ask all of you just one last question, very briefly, for all of you can tell us. Earlier we used to have like sector champions, right? NBFC dominating one company, dominating in one sector, being the big boy there. But now it almost seems like everybody is getting into pretty much everything. I mean, is that what we're going to see, over the years?
I hope not. I hope there is a diversity of business models that is out there. Even on this panel, you see people with fairly diverse business models. You have specific product champions who have over decades built spectacular institutions. You have
who are getting into other businesses as well. Leaders
yes.
in one, but
yes. But let me put it this way. Michael Jordan did try baseball for a little while. But he was Michael Jordan, and he was known for being what he was, right? So I think India is a very large country. The lending needs are extremely large, and it does need a lot of very different kinds of players to satisfy it. And I hope that 1,000 different flowers bloom in this market.
Mr. Sabharwal, any perspective?
What I have seen is this, that when you're small, probably you can focus on a single product and make it large. But the moment you become large, you need to diversify your risks because you want to be less susceptible to what happens. You want to be more granular, and that is what leads to getting diversified across asset classes. At least that is what we are seeing among large companies.
Mr. Iyer?
I think our product is money, right? And everything else is a underwriting collateral. We actually get mistaken by saying, oh, you're in vehicle, you're in housing.
But knowledge,
that's
sir,
a collateral, right?
But knowledge about a particular...
So therefore, what we do well is we recognize our product is money, and we build our knowledge around the collateral that we know to manage better. And therefore choose a segment that we want to work with. So therefore, all NBFCs will get into all products, undoubtedly in my view. But they will have a prime product which is their larger balance sheet, and there will be a supporting product which will help them bring down the cost, will help them grow a little more, will de-risk to whatever extent possible.
Sir?
There is a strong culture in any company, especially the company which is having spent 30, 40 years in the particular industry. That culture will take the lead and will be dominating in certain segment which you know very well. Then other segments also will try to do depending upon what customer needs. Most of the diversification or most of the addition of a product, most of the improvement what we do is based on what our customer wants. I don't think anyone will go into a totally new segment which is totally unknown. That's not possible. So I think every company will grow, mature, and as Rajiv rightly said, that you need to diversify a little on asset classes because of cyclicality. Because the cyclicality can hit you if you are totally dependent on one single product.
And Muthoot knows that more than anybody else, right? I mean, single product, but now diversifying.
Correct. And it is a natural progression for anything. I mean, when you grow big, you have to diversify because you want your eggs spread out in different baskets. And this asset classes are dependent on various time series also. You have products of very short time and very long tenure. So, and the repayment culture changes as per asset class. So yeah, as you grow big, it's good to diversify, but core being core, you will have a large part of balance sheet of a single product, and that should remain, I mean.
All right, I think I have many more questions, but we don't have the time, and then, so I think we'll wrap it up here. Thank you very much, all of you, Alok, Mr. Revankar, Mr. Iyer, Mr. Sabarwal, Jairam, thanks very much for joining in. I don't know if we have time for questions, should we? I mean, if we have, okay, I don't think we should. Thank you very much for being a wonderful audience, and please join us for drinks and dinner. Thanks very much.
May I please request everybody to just stay for a little while. Thank you, gentlemen. A quick round of vote of thanks. If you could all wait just for a second. May I request Mr. Parag, be safe, CEO, Nucleus Software, to come up on stage to deliver the vote of thanks.
Good evening to all of you. Thank you very much for being here. I'll really make it very quick. I extend my heartfelt gratitude to each and every one of you for gracing this event with your presence. Events like this provide us an exceptional platform to exchange ideas, share insights, and collectively shape the path forward. I feel privileged to stand before this esteemed gathering of industry leaders, experts, and visionaries who enabled us to create robust technology platforms that still remain, even after 3 decades, at the forefront of innovation and transformation. And they are operated by 200+ financial institutions across 50 countries, as Mr. Vishnu said some time back. Today is a very special day for all Indians. Our very own Chandrayaan-3 has traversed a journey so great and landed successfully on the moon. This is a proud moment for all of us to look at another great Indian organization, ISRO, who has strived hard to get India self-reliant on in-space technology. ISRO made India the first Asian nation to reach the Martian orbit and the first nation in the world to do so in its maiden attempt, amidst a lot of speculation and big bets. I hope you know what I'm talking about. It thrived with a single-minded focus of Atmanirbharta, while keeping a hawk eye on costs, never forgetting that we are a developing nation. Today, many nations are queuing up to ISRO for their launch services. India is at the center stage where Indians play a meaningful role in the community of nations, second to none, in the application of advanced technologies to solve their real-life problems. Atmanirbharta and our roles in making India self-reliant in the financial services space. However, despite our best efforts, a large proportion of unbanked communities are still unable to avail mainstream loans and end up being charged very high rates of interest, as we all heard, making it impossible for them and their generations to prosper. At Nucleus Software, we firmly believe in the power of financial inclusion as a catalyst for economic growth. Our ongoing goal extends to making a ₹100 loan possible and profitable via technology to cater to the banking needs of the underserved segments. We are passionately turned to the government's goal to achieve a $5 trillion economy and believe that financial inclusion is the most critical way forward. Indians have proven that we are adaptable and want betterment in financial services. The success of UPI today has revolutionized how Indians transact, paving the way for cashless economy. UPI has propelled the nation into a future powered by seamless digital payments, and this space is only growing at an exponential pace. By expanding credit access, fueling digital financial inclusion, and boosting consumer spending, these growth accelerators are reshaping India's economic landscape and empowering its citizens. I would especially like to congratulate and thank the solid role of the Government of India and RBI, as all our panelists have talked about, having led us to where we are today, the 5th largest economy in the world. This is no mean feat, considering the challenges that our independent India faced. The RBI has been the backbone of banking transformation in India. The forward-thinking policies of the Reserve Bank of India have been catalysts nurturing an environment ripe for innovation and industry. I once again thank our distinguished speakers and valued participants who generously shared their expertise, insights, and perspectives. Your impactful words and engagement throughout the event has driven its resounding success. I would like to thank our esteemed partner, CNBC-TV18, for putting together this unique and first-of-its-kind platform on banking transformation. As we bid adieu to this remarkable gathering, let's carry forward the camaraderie, insights, and connections we have gained, employing them as guiding beacons in our future endeavors. Let us also remember that our journey towards $5 trillion economy is not just a dream, it is a goal that demands collective effort. Jai Hind.
Well, that brings a close to the Nucleus Software presents CNBC-TV18 Banking Transformation Summit. I would like to thank Nucleus Software for making this event a successful one. A big thank you to each one of you for being such a wonderful audience. And now may I request you to join us for cocktails and dinner. Thank you.